The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. The hearing is for the purpose of receiving the semi-annual testimony of the chair of the Board of Governors of the Federal Reserve System on monetary policy in the state of the committee. I now recognize myself for 5 minutes to give an opening statement. We welcome Chair Yellen for another semi-annual Humphrey Hawkins appearance before our committee today. Her appearance performs double duty and represents the 11th hearing of our committee's Federal Reserve Centennial Oversight Project. As all members know, last week we held a legislative hearing on the first piece of legislation to arise from the project, namely the Federal Reserve Accountability and Transparency Act, co-authored by Mr. Huizenga and Mr. Garrett. Not surprisingly, its introduction was met with howling protest and apocalyptic visions from my Democratic colleagues. Regrettably, such a reaction has become commonplace on our committee, with few exceptions. My Democratic colleagues have proven they do not wish to legislate, nor do they wish to conduct oversight. It causes many to wonder why they ran for Congress in the first place, and the answer, they apparently wish to be defenders and apologists of the status quo. But with the real unemployment rate at 12.1%, 46 million Americans dependent on food stamps, real median income having fallen every year of the Obama administration, the status quo is unacceptable. Additionally, when the Federal Reserve helps precipitate the financial crisis with loose monetary policy, selectively intervenes in distinct credit markets, facilitates our unsustainable national debt, blurs the lines between fiscal and monetary policy, and has its power vastly expanded, the status quo is unacceptable. A dramatic increase in power calls for a corresponding increase in accountability and transparency, and that is precisely what the FRAT Act does. The overwhelming weight of evidence is that monetary policy is at its best in maintaining stable prices and maximum employment when it follows a clear, predictable monetary policy rule. I believe the period of the Great Moderation between 1987 and 2002 attests to this proposition. Had a clear, predictable monetary policy rule, like the Taylor Rule, been in place throughout the last decade, it is likely the financial crisis would have been avoided in the first place, or at least downgraded to a garden variety recession. The FRAT Act in no way, shape, or form dictates monetary policy. Anybody who maintains otherwise either hasn't read the Act, doesn't understand the Act, or regrettably, they are trying to mislead others. After the passage of the FRAT Act, if the Fed wants to conduct monetary policy based upon viewer text messages from the American Idol television show, it will retain the unfettered discretion to do so. If the Fed wishes to conduct monetary policy based upon a rousing game of rock, paper, and scissors on odd Tuesdays at the FOMC, it will retain the unfettered discretion to do so. The Fed can set any rule it wishes. It can change the rule any time it wishes. It can deviate from the rule any time it wishes. Under the FRAT Act, it simply has to report and explain this to the rest of us. That's what transparency and accountability are all about. For those who claim this somehow imposes upon the Fed's independence, I note that the Fed chair testifies before our committee and our Senate counterpart twice a year. The Fed chair meets with the Treasury Secretary once a week. And dare I mention the continuing revolving door between Fed officials and Treasury officials. The threat to the Fed's independence does not come from the legislative branch, it comes from the executive branch. And again, I reiterate, this has nothing to do with the FOMC deliberations or micromanagement of daily Federal Reserve operations. The Fed just wants to keep the curtains closed and keep any outside eyes from reviewing how well or how bad its biggest policies are implemented. Who knows whether the Fed's engine needs a tune-up if no one will let the mechanic look under the hood? Oh, by the way, that is not my quote. It is from former chairman of this committee, Henry B. Gonzalez, whose portrait sits to my right and who very well may have been the single most liberal Democrat to ever chair this committee. My, how the times have changed. As our witness, Dr. Mark Calabria of the Cato Institute testified last week, the reason it is important for the Fed to reveal its rule or operating model, quote, so that it can be examined and tested by those outside the Fed, Only under such examination can we learn how the model captures the real world, unquote. The Fed is yet to corner the market on PhD economists or monetary policy experts. Quite simply, the Fed's work should bear the scrutiny and critical examination of others. With respect to the other portions of the FRAT Act, it remains an open question whether the Fed should serve any role as a prudential regulator, but regardless of the answer to that question, the Fed should no longer be permitted to hide its prudential regulatory actions behind its monetary policy independence cloak. This is particularly true when we consider the Fed's sweeping powers under Dodd-Frank to control an ever-increasing share of the American economy. When it comes to prudential regulations, it is clearly time to hold the Fed to the same openness and transparency that we require of other federal agencies. This includes mandatory cost-benefit analysis, also known as common sense. Finally, many have wondered about the Fed's view of the FRAT Act. I have not. During my congressional tenure, I have yet to encounter one federal agency that has requested less power, fewer resources, or more accountability. I doubt the Fed will be the first. I now yield to the ranking member for an opening statement.
Thank you, Mr. Chairman, and welcome back, Chair Yellen. Chair Yellen, it's been 5 months since you last appeared before this committee, and in that time, much has changed. Absent major changes in our economic outlook, the Federal Reserve's program of large-scale asset purchases, known as quantitative easing, is set to end in October, and many are looking to see what the Fed will do once the program subsides. The challenges are significant. Although employment levels for many sectors have continued to rise, stable and consistent growth is uneven and not a given. In a surprise turn, GDP dropped substantially in the first quarter. Unemployment remains unacceptably high, particularly for minority groups. African Americans face an unemployment rate of 10.7%, 7.8% for Latinos. So let's be clear. While we've made much progress, the long-term effects of the financial crisis, the worst since the Great Depression, can still be felt by working people and people still looking for work in every one of our communities across the country. Of course, the problem of unemployment has only been made worse by Republican intransigence on any number of measures, from refusing to invest in our country's job-creating infrastructure to cutting investments in education that will fuel the next generation of American leaders, to their refusal to extend benefits for our friends and neighbors suffering from long-term unemployment. And other important programs that create jobs and economic growth, such as the Export-Import Bank and the Terrorism Risk Insurance Act, remain needlessly tied up in a Republican ideological war, creating widespread uncertainty for our nation's job creators. In the wake of legislative uncertainty and fiscal recklessness, some of my colleagues on the other side of the aisle are likewise attempting to stop the Fed from taking action to jumpstart our economy and preserve economic stability. They recently proposed harmful legislation that would take unprecedented steps to virtually eliminate the Federal Open Markets Committee's role in shaping monetary policy. Instead, Republicans prefer to put decisions related to inflation and employment on autopilot, determined arbitrarily based upon a rigid set of factors. If enacted, this proposal would undercut the Fed's ability to respond to emerging threats through rules and requirements designed to paralyze Fed rulemaking and to curtail monetary policy discretion. This would include concerns emanating from areas like social media, which the Fed noted just yesterday appears to be substantially stretched. Quite simply, the straitjacket approach taken in the Republican bill would leave the Fed with few options, powerless to deal with such as an emerging area of concern, even if it were to pose a danger to our economy. Whether emerging threats to financial stability come from social media or elsewhere, this short-sighted legislation would be a recipe for disaster. Chair Yellen, I'm eager to hear your views on how our economy would have fared during the crisis and in the future with such a regime in place. Finally, I'm very interested to hear about the Fed's progress in meeting the heightened regulatory policy mandate entrusted to the institution under the Wall Street Reform Act. In particular, I want to urge the Fed to expeditiously implement the unfinished provisions of the Act and to faithfully enforce the provisions of the law, provisions like robust living wills and a strong Volcker rule that provide the tools for preventing the next 2008 crisis. Thank you, Mr. Chairman, and I yield back the balance of my time.
The Chair now recognizes the gentleman from Michigan, Mr. Hai Zinga, the Vice Chairman of our Monetary Policy Subcommittee and co-author of the Federal Reserve Accountability and Transparency Act, for 3 minutes.
Thank you, Mr. Chairman. And as predicted, the apocalyptic view has emerged already here in regards to my particular bill. But I do have to say that, Chair, I give you credit. I watched some of your testimony last evening on TV of what you did in the Senate, and I give you credit for coming in front of this committee and giving us time. You've been very generous with that. But we both know that over the past several years, the Federal Reserve has gained unprecedented power, influence, and control over the financial system while remaining shrouded in mystery to the American people. This standard operating procedure, I believe, can't continue. We must lift the veil of secrecy and ensure that the Fed is accountable to the people's representatives. This is not about your independence or the independence of the Federal Reserve, but about accountability and transparency. And at this point, I won't go on my oversight rant that I did back at our hearing on the bill, where I just don't understand why many of my colleagues aren't interested in embracing the responsibility of their job to go and exercise oversight, and have a lack of interest in doing that. But last week, my colleague Scott Garrett and I introduced H.R. 5018, and this legislation will start to pull back the curtain at the Fed to increase accountability and transparency. The Dodd-Frank Act bestowed massive new regulatory authority upon the Federal Reserve, yet the Fed is not required to conduct cost-benefit analysis when it considers new regulations, unlike all the other financial regulators, such as the SEC and the CFTC. Additionally, this legislation urges the Fed to adopt a rules-based approach, as the Chairman had talked about, to the monetary policy, instead of the continued ad hoc strategy currently being employed. Should the Fed fail to adopt a rules-based approach, it would trigger an audit of the Fed's books. And unlike the view that this is going to somehow chill this, I can tell you that many people believe this doesn't go far enough. In fact, I support that as well, and I never thought that I would agree with the former Chairman Henry Gonzalez about doing an audit of the Fed. But if it was good enough for him in 1993, I think it's probably good enough for us here at the Centennial as well. But additionally, this legislation urges the Fed to, economists across the ideological spectrum have called upon the Fed to set this kind of monetary policy according to a mathematical rule that uses economic data, such as the rates of inflation and unemployment, and to share that rule with the public. We cannot have a power entity within the Federal Government without just operating on a whim. This legislation codifies the common sense principle of using a rules-based approach when determining monetary policy. And I believe it's time to bring the Federal Reserve out of the shadows and provide hardworking taxpayers with a more open and transparent government. You know, my bill last week was labeled Spanish Inquisition. It was all kinds of other things thrown around. But again, I believe it's our job, our constitutional duty, our constitutional responsibility to work with you and to have oversight of what the operations are. And with that, Mr. Chairman, I yield back. Thank you.
Time of the gentleman has expired. The Chair now recognizes the gentleman from New York, Mr. Meeks, the ranking member of our Financial Institutions Subcommittee, for 1.5 minutes.
Thank you, Mr. Chairman. Thank you, Madam Chair. Chair Yellen, it is with great pleasure that we welcome you here again this morning, and I want to extend my deep appreciation to you and your staff for the significant amount of time you have spent on the Hill, and also for welcoming congressional staffers at the Federal Reserve. That's tremendously important. I, too, was listening to some of your testimony yesterday before the Senate Banking Committee, and you mentioned that the United States labor markets are far from healthy. I applaud your remarks, and I think that you are absolutely right. The latest data from the Bureau of Economic Analysis show that Americans' personal income is barely growing at a tepid rate of only 0.3%. In fact, other reports indicate that the American real wages are still lower than before the crises. Members of this chamber are closest to the American people that we represent in Congress. And I can assure you that we hear loudly and clearly from them that they're not feeling this recovery. In fact, when preparing for this hearing, I took to social media just asking them to ask, what questions they would like me to ask you and what were their current conditions. And they said, too many, they said, especially the younger Americans, they are struggling to get jobs. And when they do get jobs, the wages are barely sufficient to make ends meet. Too many have been unemployed for more than 2 years and 3 years or more, and they have exited the job market out of frustration. Too many are concerned about their job security and their ability to save or invest in their future. Thank you, and I wait to hear your testimony, Madam Chair.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Alabama, Ms. Sewell, for a minute and a half.
Mr. Chairman and Ranking Member, I want to add to the add my voice to the choir of those welcoming Chair Yellen here today. Today's hearing with Chair Yellen is critically important as we receive an update on the state of the economy and the Federal Reserve's essential role in our economic recovery. I want to applaud the chair lady and the entire Federal Reserve for their diligent work towards fulfilling its congressional mandate of helping maximize employment, stabilize prices, and moderate long-term interest rates. Thanks in part to the Federal Reserve's insight and pragmatic monetary policies, our economy continues to experience positive and steady economic growth. I also want to encourage the Federal Reserve to continue to work as quickly as possible to enact rules that fulfill the promise of strengthening our financial system and protecting our consumers. As this committee continues to engage in conversation with key individuals surrounding the state of our national economy, we must be ever vigilant in working to ensure that we avoid any and all self-inflicted economic setbacks. It is important that we hear from Chair Yellen and work to pass legislation that fosters a stronger and more resilient financial system, rather than enacting strict policy rules that would impair the Federal Reserve's ability to do its job. We must develop and promote fair and balanced monetary economic policies that ensure the long-term growth and vitality of our economy. The American people deserve nothing less. Thank you.
Gentlelady yields back. Before introducing our witness, I wish to make a scheduling announcement. Contrary to the chair's last appearance, where she stayed to answer all member questions, she is requested to be excused at 1 p.m. For today's hearing and for future hearings. So I wish to alert members of that. I have neither the desire nor the ability to hold the chair against her will, but I am disappointed in the change of heart. Notwithstanding my disappointment, Chair, you are nonetheless welcome. We welcome your testimony today. Chair Yellen has previously testified before our committee, so I believe she needs no further introduction. Without objection, Chair Yellen's written statement will be included in the record. Chair Yellen, you are now recognized for your oral presentation of your testimony.
Chairman Hensarling, Ranking Member Waters, and members of the committee, I'm pleased to present the Federal Reserve's semi-annual monetary policy report to the Congress. In my remarks today, I will discuss the current economic situation and outlook before turning to monetary policy. I'll conclude with a few words about financial stability. The economy is continuing to make progress toward the Federal Reserve's objectives of maximum employment and price stability. In the labor market, gains in total non-farm payroll employment averaged about 230,000 per month over the first half of this year, a somewhat stronger pace than in 2013, and enough to bring the total increase in jobs during the economic recovery thus far to more than 9 million. The unemployment rate has fallen nearly 1.5 percentage points over the past year and stood at 6.1% in June, down about 4 percentage points from its peak. Broader measures of labor utilization have also registered notable improvements over the past year. Real gross domestic product is estimated to have declined sharply in the first quarter. The decline appears to have resulted mostly from transitory factors, and a number of recent indicators of production and spending suggest the growth rebounded in the second quarter. But this bears close watching. The housing sector, however, has shown little recent progress. While this sector has recovered notably from its earlier trough, housing activity leveled off in the wake of last year's increase in mortgage rates, and readings this year have overall continued to be disappointing. Although the economy continues to improve, the recovery is not yet complete. Even with the recent declines, the unemployment rate remains above Federal Open Market Committee participants' estimates of its longer-run normal level. Labor force participation appears weaker than one would expect based on the aging of the population and the level of unemployment. These and other indications that significant slack remains in labor markets are corroborated by the continued slow pace of growth in most measures of hourly compensation. Inflation has moved up in recent months, but remains below the FOMC's 2% objective for inflation over the longer run. The Personal Consumption Expenditures, or PCE price index, increased 1.8% over the 12 months through May. Pressures on food and energy prices account for some of the increase in PCE price inflation. Core inflation, which excludes food and energy prices, rose 1.5%. Most committee participants project that both total and core inflation will be between 1.5% and 1.75% for this year as a whole. Although the decline in GDP in the first quarter led to some downgrading of our growth projections for this year, I and other FOMC participants continue to anticipate that economic activity will expand at a moderate pace over the next several years, supported by accommodative monetary policy, a waning drag from fiscal policy, the lagged effects of higher home prices and equity values, and strengthening foreign growth. The committee sees the projected pace of economic growth as sufficient to support ongoing improvement in the labor market with further job gains, and the unemployment rate is anticipated to decline toward its longer-run sustainable level. Consistent with the anticipated further recovery in the labor market, and given that longer-term inflation expectations appear to be well anchored, we expect inflation to move back toward our 2% objective over coming years. As always, considerable uncertainty surrounds our projections for economic growth, unemployment, and inflation. FOMC participants currently judge these risks to be nearly balanced, but to warrant monitoring in the months ahead. I will now turn to monetary policy. The FOMC is committed to policies that promote maximum employment and price stability consistent with our dual mandate from Congress. Given the economic situation that I just described, we judge that a high degree of monetary policy accommodation remains appropriate. Consistent with that assessment, we have maintained the target range for the federal funds rate at 0 to 0.25% and have continued to rely on large-scale asset purchases and forward guidance about the future path of the federal funds rate to provide the appropriate level of support for the economy. In light of the cumulative progress toward maximum employment that has occurred since the inception of the Federal Reserve's asset purchase program in September 2012, and the FOMC's assessment that labor market conditions would continue to improve, the committee has made measured reductions in the monthly pace of our asset purchases at each of our regular meetings this year. If incoming data continue to support our expectation of ongoing improvement in labor market conditions and inflation moving back toward 2%, the committee likely will make further measured reductions in the pace of asset purchases at upcoming meetings, with purchases concluding after the October meeting. Even after the committee ends these purchases, the Federal Reserve's sizable holdings of longer-term securities will help maintain accommodative financial conditions, thus supporting further progress in returning employment and inflation to mandate consistent levels. The committee is also fostering accommodative financial conditions through forward guidance that provides greater clarity about our policy outlook and expectations for the future path of the federal funds rate. Since March, our post-meeting statements have included a description of the framework that is guiding our monetary policy decisions. Specifically, our decisions are and will be based on an assessment of the progress, both realized and expected, toward our objectives of maximum employment and 2% inflation. Our evaluation will not hinge on one or two factors, but rather will take into account a wide range of information, including measures of labor market conditions, indicators of inflation and long-term inflation expectations, and readings on financial developments. Based on its assessment of these factors, in June, the committee reiterated its expectation that the current target range for the federal funds rate likely will be appropriate for a considerable period after the asset purchase program ends, especially if projected inflation continues to run below the committee's 2% longer run goal, and provided that inflation expectations remain well anchored. In addition, we currently anticipate that even after employment and inflation are near mandate consistent levels, economic conditions may, for some time, warrant keeping the federal funds rate below levels that the committee views as normal in the longer run. Of course, the outlook for the economy and financial markets is never certain, and now is no exception. Therefore, the committee's decisions about the path of the federal funds rate remain dependent on our assessment of incoming information and the implications for the economic outlook. If the labor market continues to improve more quickly than anticipated by the committee, resulting in faster convergence toward our dual objectives, then increases in the federal funds rate target likely would occur sooner and be more rapid than currently envisioned. Conversely, if economic performance is disappointing, then the future path of interest rates likely would be more accommodative than currently anticipated. The committee remains confident that it has the tools it needs to raise short-term interest rates when the time is right and to achieve the desired level of short-term interest rates thereafter, even with the Federal Reserve's elevated balance sheet. At our meetings this spring, we have been constructively working through the many issues associated with the eventual normalization of the stance and conduct of monetary policy. These ongoing discussions are a matter of prudent planning and do not imply any imminent change in the stance of monetary policy. The committee will continue its discussions in upcoming meetings, and we expect to provide additional information later this year. The committee recognizes that low interest rates may provide incentives for some investors to reach for yield, and those actions could increase vulnerabilities in the financial system to adverse events. While prices of real estate, equities, and corporate bonds have risen appreciably, and valuation metrics have increased, they remain generally in line with historical norms. In some sectors, such as lower-rated corporate debt, valuations appear stretched, and issuance has been brisk. Accordingly, we're closely monitoring developments in the leveraged loan market and are working to enhance the effectiveness of our supervisory guidance. More broadly, the financial sector has continued to become more resilient as banks have continued to boost their capital and liquidity positions, and growth in wholesale short-term funding in financial markets has been modest. In sum, since the February Monetary Policy Report, further important progress has been made in restoring the economy to health and in strengthening the financial system. Yet too many Americans remain unemployed, inflation remains below our longer-run objective, and not all of the necessary financial reform initiatives have been completed. The Federal Reserve remains committed to employing all of its resources and tools to achieve its macroeconomic objectives and to foster a stronger and more resilient financial system. Thank you. I'd be pleased to take your questions.
Chair now recognizes himself for questions. Chair Yellen, my first question is going to have to do with Mr. Huizinga's and Mr. Garrett's legislation. On the one hand, it's only been in the public domain a little over the week. On the other hand, it's only 31 pages long. But have you had a chance to read and review this legislation?
I have had a chance to review the legislation, yes.
Yesterday, before Senate banking, you opined that under this legislation, the Fed would not have had flexibility to take the actions that it took during the financial crisis. I would commend for your review Section 2E, subsection C of page 7 of the legislation entitled Changing Market Conditions, which reads in part, "Nothing in this act shall be construed to require that the plans with respect to the systematic quantitative adjustment of the policy instrument target described under subsection C2 be implemented if the Federal Open Market Committee determines that such plans cannot or should not be achieved due to changing market conditions." I personally don't believe the language could have been any clearer. It is not the intent of the legislation, and would certainly welcome any policy feedback from your experts to assure that it achieves that purpose. But I believe the language is about as clear as the language could possibly be. Chair Yellen, let's talk a little bit about independence. Larry Summers, in a famous paper in the Journal on Money, Credit, and Banking on central bank independence, measures independence as, quote, "the institutional relationship between the central bank and the executive, the procedure to nominate and dismiss the head of the central bank, the role of government officials on the central bank board, and the frequency of contacts between the executive and the bank." Do you agree or disagree with his characterization of Federal Reserve independence?
I see Federal Reserve independence. Of course, I mean, we are a creature of Congress. We have a responsibility to report to Congress, and you use the term executive branch, I think, in the material.
Well, I used the term that Larry Summers used in his paper, yes.
So I see us as needing to report regularly to Congress about our conduct of monetary policy in the economy.
Let me ask you this question, Chair Yellen. I think it is well established. I'm under the impression, again, you're required to appear before our committee and Senate banking on a semi-annual basis. Is it true that there is a weekly meeting between you and the Secretary of Treasury?
Many weeks. I mean, it's not every
Most
single
weeks.
weeks. Many weeks we get together and confer about matters of mutual concern, but we are completely independent from the executive branch in the
Well,
conduct
speaking of matters
monetary
of
policy.
mutual concern and independence, I'm certainly not interested in a transcript of a private luncheon, but would you be willing to report to this committee on the matters of mutual concern that were discussed and any agreements reached between Treasury and the Federal Reserve?
I'm not willing to report on a regular basis in private conversations that I have, but any agreements that were reached certainly would be in the public domain, but our conversations
How would they
do
get
not
into the
result-
public domain?
Well, if there were an
If you don't
agreement-
report them, how do they get into the public domain? Agreements between the Federal Reserve and Treasury.
I mean, there was, for example, during the financial crisis, a question as to what is the appropriate role of the Federal Reserve in lending programs, and when does the Treasury need to be involved, when is there a fiscal component, and those discussions led to a formal agreement between the Treasury and the Federal Reserve.
My
that
time is
certainly
starting
was
to
put in
wind
the
down, if I
public
could.
domain.
Another matter. On page 3 of your testimony, it reads, quote, even after the committee ends these purchases, so we're speaking of tapering, quote, the Federal Reserve's sizable holdings of longer-term securities will help maintain accommodative financial conditions, thus supporting further progress in returning employment and inflation to mandate consistent levels. Is there any current plan or any current commitment to reduce the Fed's balance sheets to historic levels? And I'm not speaking of what you may want to do or what you might do, but is there any current commitment or plan to reduce the Fed's balance sheet to historic levels?
Well, the FOMC stated in 2012, I believe, we issued a set of exit principles in which one of the principles was that over time we sought to normalize the size of our balance sheet and to bring it down to the smallest level consistent with the efficient and effective conduct of monetary policy.
Chair Yellen, would you characterize that then as a current plan or current commitment to reduce the Fed's balance sheet to historic levels?
I would characterize it as a current plan. We are discussing our principles for the normalization of policy, and as I indicated in my testimony, I expect we will be able to give more complete guidance later this year when those discussions are complete, and I fully expect that we would reiterate an intention over time to reduce the size of our balance sheet.
Thank you. The chair now recognizes the ranking member.
Thank you very much. Legislation that was offered by the Republicans in our committee last week would require the Federal Reserve's Federal Open Market Committee to issue a rule to dictate the course of monetary policy. In your view, how feasible would it be to design a rule that would act as an appropriate substitute for independent judgment and discretion in the determination of monetary policy? And do you expect that such a rule could adequately respond to the range of economic data that affect the economy on any given day?
I feel, Congressman, that it would be a grave mistake for the Fed to commit to conduct monetary policy according to a mathematical rule. No central bank does that, and I believe that although under the legislation we could depart from that rule, the level of short-term scrutiny that would be brought on the Fed in real-time reviews of our policy decisions would essentially undermine central bank independence in the conduct of monetary policy. And I believe that global experience has shown that we have better macroeconomic performance when central banks are removed from short-term political pressures and given the independence to, within a framework in which their goals are clear, and in our case, those are specified by Congress, are given operational independence to decide how to conduct monetary policy. The Federal Reserve is the most transparent central bank, to my knowledge, in the world. We have made clear how we interpret our mandate and our objectives and provide extensive commentary and guidance on how we go about making monetary policy decisions. We do, I should say, routinely consult the recommendations of a whole variety of rules in thinking about monetary policy. And I've indicated previously in speeches I've made that these can be useful starting places or guides to policy. So I'm not 100% negative on using rules in thinking through what we should do. But I think it's very important to understand that had we followed, in the aftermath of the financial crisis, the recommendations of any of the simple rules that are widely discussed, the outcomes would have been even more disappointing than what we experienced. With the Federal Reserve's conduct of policy departing very substantially from what those rules would have recommended, we have had a long, slow grind to get this economy recovering. Now, we actually could not have followed the recommendations of a simple rule. Almost every rule would have called during, for example, 2011 and 2012 for negative interest rates, something that's impossible. And that is one reason that we began to buy asset purchases. We needed a further tool. Given the fact that we have had unusual headwinds constraining this recovery, I believe it's utterly necessary for us to provide more monetary policy accommodation than those simple rules would have suggested. And I think history would show that following any of those simple rules would have given us very much worse performance. So I feel it would be a mistake, although those rules sometimes do have merit in kind of normal times during the Great Moderation when there were relatively few shocks. And the Federal Reserve's behavior was very rule-like. It corresponded to some of those rules, and they can work well, but not always. And we can't be mathematically bound to a simple formula.
I'd like to thank you for that explanation. You could not be clearer, and you could not have explained better to this committee why you certainly could not operate with some cookie-cutter rule when, in fact, as you explained, the headwinds that you were confronted with or that the feds were confronted with required discretion. It did absolutely required that you have the flexibility to deal with unforeseen circumstances in having to make your decisions. And I want to thank you very much. And I yield back the balance of my time.
Chair now recognizes the gentleman from Michigan, Mr. Huizinga, Vice Chairman of our Monetary Policy Committee.
Thank you, Mr. Chairman. I've got a quick question, Chair Yellen. Have you read my bill, the Garrett Huizinga bill?
I have looked at the bill.
You have looked at it? Okay. Well, that's good news. I will then, I guess, just refresh your memory and address my colleague from California. We anticipated that that might be a concern of yours. So on page 8 of the bill, under subsection 2, the GAO approval of an update, and we're not going to get into whether there should or shouldn't be, the rule, or does the rule go far enough, et cetera, et cetera. However, it does say, upon determining that the plans described in paragraph 1 cannot or should not be achieved The Federal Open Market Committee shall submit an explanation for that determination, an updated version of the directive policy rule to the Comptroller of the United States and appropriate congressional committees. It goes on to say that then if they determine that you're not in compliance with the new rule, then you get audited. All right? It does not say that you cannot change the rule. What it says is you have to notify us and notify them. Now, I'm a history buff, all right? So went back and did a little history. We got to where we are today because of the Employment Act of 1946, where Congress felt it needed to lay out what Fed policy was. In the 70s, they felt Congress, my colleagues, felt it was too vague and therefore created a bill that would strengthen and clarify the 1946 Act. It actually had 3 goals, not 2. It's not a dual mandate. It's actually a tri-mandate by Congress: stable prices, maximize employment, and moderate long-term interest rates. Okay? So on page 3 of your testimony, you're talking about, and I'm going to quote, it's the second paragraph down, even after the committee ends these purchases, the Federal Reserve's sizable holdings of longer-term securities will help maintain accommodative financial conditions, thus supporting further progress in returning employment and inflation to mandate consistent levels. Where in the Humphrey-Hawkins Act, which was signed, oh, by the way, I'm sorry, my colleagues, by Jimmy Carter in 1978 after Democrats in the House and the Senate passed the bill, where in the Humphrey-Hawkins Act do we lay out a 2% inflation rate? Do we do that?
You do not make specific in the legislation.
Do we lay out exactly what employment rates or unemployment rates should be?
The FOMC has...
No, I'm sorry, Congress. The bill that was passed by Democrats in the House and the Senate and signed by Jimmy Carter, does that mandate what the employment rate should be?
The bill uses the term, as you said, maximum employment and price stability. Okay, so we don't prescriptively say it's going to be a 2% inflation rate target and 5 or 6% unemployment rate. Is obviously with language of the type that's in the legislation. We need to interpret.
Do we lay it out?
You do not.
Okay, all right, there we go. All right, so I am curious how us requesting a rule, a simple step in most people's view, a simple rules-based policy, how is that different than the mandate, the tri-mandate that was laid out in Humphrey-Hawkins and defended every single day by others in this committee? How, when we're asking for what the rule is, not telling you what the rule is, not being prescriptive or even descriptive, but just say, set a rule, and then let us know so that we can have oversight. I here will reference my rant on oversight to my colleagues who can go back and watch it on YouTube if they weren't in the committee room. So if we can get as detailed as the Humphrey-Hawkins Act, or lack of detail, why can't we have a rule and have you all at the Fed accept that? And if you're not willing to accept it because you're concerned about your independence, is that one of them? I don't want to put words in your mouth. Is that one of your reasons why you don't want to sign on to the Garrett-Huizinga bill? Well,
I'm not aware of any literature that establishes that adopting a central bank, whether it makes it public or not, adopting a rule is the most desirable way to run monetary policy. And I would say that many...
Might want to talk to the Europeans about that and a lot of other economists as well.
Well, what the Europeans do is the ECB has been given a great freedom, and they have defined a price stability objective.
All right. Well,
they certainly do not...
Here's my last request. If the Garrett-Huizinga bill isn't good enough, I would like to know when the Fed is going to call for a rescission of the Humphrey-Hawkins Act because it impedes your independence.
The time of the gentleman has expired. The Chair now recognizes the gentlelady from New York, Ms. Maloney, Ranking Member of the Capital Markets Subcommittee.
Thank you and welcome, Madam Chair. I'd like to ask you about the Fed's exit from its monetary stimulus. As you testified, the Fed is currently on pace to wind down its QE3 purchases by the end of October. But right now, the market isn't expecting the Fed to start raising interest rates until the third quarter of 2015. So between October of this year and the third quarter of 2015, what are the main tools that the Fed anticipates using to exit from its monetary stimulus?
Well, thank you. As I indicated, if the committee continues to see improvement in the labor market and continues to forecast ongoing progress in the labor market over time and inflation moving back toward 2%, it is our intention to wind down our asset purchases, to conclude them after the October meeting. Beyond that, we would maintain the 0 to 1/4% range for the federal funds rate that we've maintained now for many years. And eventually, as the economy makes further progress, would begin to raise our target for short-term interest rates. And while we've not laid out a specific timeline for doing that, we have given a general principle, which is we will be assessing what our actual progress is and then our expected future progress is toward attaining the two objectives of maximum employment and price stability. So we will be looking at how far are we from our objectives and how rapidly are those gaps closing. Now, that's a matter that we can't be certain about. We make forecasts, but incoming data causes us over time to change those forecasts. So I can't be specific about what the timing of ultimate increase in our target for short-term interest rates would be, but we will be assessing incoming information. Now, we do give participants in the FOMC, these are not FOMC policy statements, but we have provided in the monetary policy report, and we provide every 3 months information about each FOMC participant's assessment of both the economic outlook and their views on the likely path of monetary policy. So again, this is each individual's view. Walking into our June meeting, as a committee, we have to transform that into a single policy. But it gives some indication, I think. And given their expectations for progress in the labor market and inflation, at the beginning of our June meeting, FOMC participants, almost all of them, saw it appropriate to begin raising our target for the federal funds rate sometime during 2015. The median participant saw the federal funds rate by the end of that year standing around 1%. So while there's no exact timing of obviously in 2015, it is in some sense roughly consistent with what you said, but market expectations are. But again, I want to emphasize that the actual progress we see in the labor market and inflation and our general assessment of the labor market could change that over time, so there's no mechanical formula and no clear date.
Okay. Will the Fed start changing the interest rate on excess reserves held at the Fed during this time?
When we decide to raise our target for short-term interest rates, a key tool will be to raise the interest rate we pay on excess reserves. So we would only raise the interest rate on excess reserves when we have determined that the time has come to begin raising short-term interest rates more generally. That will be a key tool that we will use.
Last week, Federal Reserve Vice Chairman Stanley Fischer gave a speech in which he suggested that adding a financial stability mandate to the overall mandates of all the U.S. financial regulators could help improve financial stability. Can you comment on the effect that adding an explicit financial, I guess I'll get that in writing, a response. My time has expired. Thank you. Thank you.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Alabama, Mr. Backus, the chairman emeritus of our committee.
Thank you. Chair Yellen, let me begin by saying that this will be my final federal monetary policy hearing that I'll participate in as a member of Congress since I'm retiring at the end of this year. During my 22 years of service on this committee, including my 6-year term as ranking member and then chairman, I've heard testimony from the Federal Reserve Chair, Alan Greenspan, Ben Bernanke, and now, of course, yourself. My observation during these times of both prosperity and during times of financial crisis is that we have leaders and a professional staff at the Fed who have conducted themselves with honor and who have been true public servants. So let me thank you, as well as your professional staff, and as well as your predecessors, for serving the people of America in this most important and tremendously demanding position.
Thank you, Congressman. I appreciate that.
Thank you. We've seen that FSOC, where the Fed is obviously a key player, exercise the authority granted by Dodd-Frank to designate institutions as SIFIs are financially, systemically important. This has included asset managers and insurance companies, which has been somewhat controversial. My experience is that there is often a greater resistance to a designation or a ruling when the parties feel they hadn't been consulted or the process is not transparent enough. So one of the approaches that is attracting some interest is to require that companies being considered for a SIFI designation be provided with specific reasons why, and also a description of steps they could take so they might not be named as SIFIs. And this would be between the particular company and the Fed. It wouldn't be a public discussion. Do you agree, or would you consider that as a reasonable approach? It would bring greater transparency to the SIFI designation process. And I think laying out a clear methodology actually leads to more certainty and confidence in the process, and I think would be accepted more readily.
Well, this is clearly a very important thing that happens to a company when it's designated, and I believe it utterly has to be given every opportunity to understand the logic of why the FSOC is thinking that it poses systemic risk, and every opportunity to present its own analysis of the issues and to interact with the staff and having a very good and frank dialogue and back and forth. And I believe that that is part of the process. And the firms are given every opportunity to intensively interact with the committee and its staff before any organization is designated as a SIFI. That is completely appropriate. Now, in that process, there is a great deal of confidential information. So right. I don't feel it's appropriate for that to take place in the public domain.
Well, and I would agree with you. I'm talking about a give and take between the parties.
I think that is absolutely appropriate. And to the best of my knowledge, I mean, I've not served on FSOC when any institution's been designated, but to the best of my knowledge, when the institution gets into the latter stages of the process, there is a great deal of back and forth.
Thank you. Let me talk about some demographic influences on labor force participation, because I know that concerns you, it concerns all of us. Part of it is the rise in the service sector employment, where we've gone to a lot of part-time employment. Some good reasons by choice, some not. But also many analysts think that it's being driven in part by aging U.S. population, particularly as retirees exit the workforce. Does the Fed take that into consideration when they talk, if labor force participation doesn't pick up and growth does, how does that affect your decision to keep rates low?
A very brief answer, please.
I fully agree with your point. Demographics in an aging population is driving and should be expected to drive the labor force participation rate down. So the question is, has labor force participation fallen more than would be expected based on demographics? And my personal judgment is, yes, it's fallen somewhat more than that, but aging is a very important downward force, and that's what I expect going forward.
The time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Velasquez, for 5 minutes.
Thank you, Mr. Chairman. Madam Chair, with the prospect of 0% interest rates coming to an end, some have warned that this could unduly hamper economic growth. Yet, artificially low interest rates pose a real threat of creating asset bubbles. What has the Fed seen in the markets concerning asset prices, and does the threat of a bubble outweigh any slowdown in economic growth?
So the Federal Reserve has been increasingly and intensely focused on financial stability, and we understand that maintaining interest rates at low levels for a long time can incent reach for yield or asset bubbles. So we are monitoring this very closely, and that's in part why I referenced some of these trends in my opening testimony. My general assessment at this point is that threats to financial stability are at a moderate level and not a very high level. Some of the things that I would look at in assessing threats to financial stability to see if they're broad-based, broad measures of asset prices, of equities, of real estate, of debt. Do they seem to be out of line with historical norms? And I think there the answer is no. Some things may be on the high side, and there may be some pockets where we see valuations becoming very stretched, but not generally.
Thank you. Thank you.
The use of leverage is not broad-based. It hasn't increased, and credit growth is not at alarming levels by any means.
Thank you. Although the economy is recovering at an accelerated pace, many experts have warned of the disconnect between stock market gains and overall economic growth. What impact are the Fed's current monetary policies having on this phenomenon?
Low interest rates, an environment of low interest rates are one factor that affect asset prices, generally including equities. And so a low interest rate policy, I think, partially accounts for why housing prices have rebounded and also is an influence on equity prices. But it's not the only influence. The economy is recovering, and earnings have been.
But do you find this an issue to be concerning to you? Is it concerning to you?
The issue being that monetary policy affects asset prices?
Yes.
That is one of the.
Well, the disconnect between stock market gains and overall economic growth.
So I don't have a view. The Federal Reserve doesn't take a view as to what the right level of equity or asset prices should be, but we do try to monitor to see if they are rising outside of levels consistent with historic norms. And as I indicated, in spite of the fact that equity prices, broad indices, have risen substantially, price equity ratios and other measures are not outside of historical norms. And I don't know what the right level of prices is, but in that sense, I'm not seeing
Thank you.
Alarming warning signals.
As we all know, the economy has been creating jobs at an accelerating pace recently, despite fears that tapering the Fed's qualitative easing could slow the recovery. In your opinion, is this strong evidence that the economy has turned the corner and now is healthy enough to self-sustain the recovery?
I am optimistic about the economy, and that's reflected in the forecasts that are included in the monetary policy report. We had a very surprising negative growth in the first quarter, which is a number that in a way doesn't seem consistent with the underlying momentum in the economy and many indicators of spending and production. And I do think the economy is recovering and that growth is picking up and that we have sufficient growth to support continued improvement in the labor market. And we have seen, maybe not progress over many years at the pace that would be ideal, but real progress that will continue.
Thank you.
Time of the gentlelady has expired. The chair now recognizes the gentleman from New Jersey, Mr. Garrett, chairman of our Capital Markets Subcommittee.
So I thank you, Mr. Chairman, Mr. Chair. So a couple of questions. We finally, over here, on this side.
Oh, sorry.
There you go. That's okay. Finally, after many, many months, we've got responses to the questions that we put to you months ago. One of the questions came about because one of the Fed governors have stated that they believe that a failure of a large broker-dealer would be disabling to the economy. So we asked you, do you support expanding the Fed's discount window access to broker-dealers and other non-banks during turbulent economic times to expand your regulatory, do so? And you said no. You said, I do not favor expanding the Fed's discount window to broker-dealers and non-banks. Instead, you say you support the application of stringent capital standards and liquidity requirements, and also you said you support the development of resolution regimes. I get that. If those regulations and the resolution regimes do not work, do you then rule out access to broker-dealers and other non-financial institutions to the discount window? Is that what you're saying? You rule that out?
Well, under the terms of Dodd-Frank Act, the Federal Reserve is barred from extending discount window lending to an individual firm.
Right.
And we are confined to broad-based facilities.
Right. So would you rule out then extending 13.3 as well?
So if there were general financial disruption and we were in a situation of systemic risk similar to what we saw during the financial crisis, where we have a general panic.
Then you would use 13.3 to allow broker-dealers to have access to either 13.3 potentiality or access to the broker-dealer or to the discount window, is what you're saying, under those circumstances.
I believe a broad-based scheme in a situation of systemic risk
so we would
is
be
a possibility, but it is something that would have to be very seriously
right.
considered.
So we would be actually extending the American public backstop to broker-dealers under your administration, potentially, under the right circumstances, what you just said. That's what I heard.
It depends what the circumstances are, but again, I want to emphasize
that's quite astounding that broker-dealers and other non-banks will now know or on notice that they may have, under the right circumstances, 13.3.
It would have to be unusual and exigent, and it would have
to... Understood, but now we know. Secondly, Secretary Lew was here, sitting where you were sitting recently, talking about the FSB, and after much questioning and answering, we asked him, what's the process? And he says, well, the FSB does not acts in a consensus manner. And we said, well, did you, Secretary Lew, consent to the designation of specific globally systemic financial firms? And he said, yes, he did consent to them. So my question to you is very simply, did you agree with Secretary Lew? Did you also consent to those designations of globally systemic firms, or did you take a contrary view? Did you object?
Well, I have to say I was not at the time involved in any way with the FSB, and I am not I am not at this time either.
So you do not take part. You do not take part in any discussions with FSB as far as the determination of globally systemic.
I have personally not been involved in those discussions. Governor Cerullo is our representative to the FSB, and he has been
Governor
involved.
Cerullo is our representative, and not you. Has he consented, as far as you know?
He may well have been involved in those discussions and consented. You would have to pose that question to him.
Okay, he doesn't come up to testify. That was one of the provisions of our bill to see whether we could get him to come start up here to testify on that section. But okay, do you believe that? Speaking of, sort of speaking of which, over with regard to FSOC, we sent a letter to head of the New York Fed, Dudley, with regard to his involvement with FSOC. He's an active participant, is my understanding. Is that correct with FSOC?
I believe he has the status of observer.
Well, my understanding is that you have given him active participation status. Is that correct, or is he just an observer?
I am not in a position to make any rules about who can or cannot attend FSOC. Those are done by the leadership, which is in.
Well, you allow him to attend, and even though not, would you allow members of this committee to attend?
It was not my decision.
To allow him to attend?
Time of the gentleman has.
Can I just get an answer whether it was her decision or not, whether he should attend? Who allowed him to attend these meetings?
Brief answer, please.
I believe the Treasury Secretary.
Thank you.
Chair now recognizes the gentleman from California, Mr. Sherman.
Chairman Yellen, we learn a lot from you. Thanks for being here. You also have a chance to learn from us, not because we have any great economic theories worthy of your consideration, but because we represent 60-plus districts from coast to coast. We're intensely aware of what's going on in our districts, and we prove that biannually. And the reports you get from members of this room as to what's happening in their districts are uniform, even though our economic theories are disparate and in many cases unworthy of your attention. The economy is worse than your statement indicates. There isn't a person in this room who has waxed eloquently about how everything's going spectacularly in their district. And many, many members have told me and spoken about how in a very large percentage of this country we're still in recession. A second reason for you to push toward more quantitative easing and a continuation of low interest rates is that you have very few tools left if we slip back into recession. And you have all the inflation fighting tools still available to you. I think you understand that. There's a second area where I think you can learn from us, and that's not in the monetary policy area, but you're a top bank regulator. We had an exchange back in February in which you described how important it was to loan money in local communities. And I explained to you, and I've talked to my colleagues here, your regulators haven't gotten the memo. You can send them a copy of the remarks you made in response to my question in February. Many, many small businesses can't get loans even with an appropriate risk premium. In fact, if you're trying to borrow money at prime plus 5, oh my God, you're terrible. We can't talk to you. Rather than the idea that you're going to make 100 loans and one of them's going to go into default, it's you're going to buy 100 government bonds, and that's not a way that a bank can contribute to the economy. You may remember back in February we talked about the Financial Accounting Standards Board lease accounting project, which would capitalize all leases and add $2 trillion to the liabilities of balance sheets of American business. And at that time you indicated that you'd have your staff look at this, both in terms as to whether you would want to comment on something that other economists have said will cost $400 billion to our GDP, as companies try to rebalance their balance sheets, and because nobody can build a big building without a long-term tenant. And if you penalize companies for signing long-term leases, you're not going to have long-term tenants. I wonder if you could at least recommit to having your staff look at that, perhaps be willing to comment on it, because those folks at the Financial Accounting Standards Board, the slightest hint from you or your staff would be very instructive to them. If they won't listen to you, at least you could price into your economic projections an economic risk that only an accountant would bring to your attention. I wonder if you can comment on the lease accounting.
We will have a look at that and try to get back to you.
Okay. As to designating SIFIs, I hope that you would focus not on the size of an entity's assets, but the size of their liabilities. It was Lehman Brothers' inability to pay its liabilities that was the final straw that broke the economy. If you had some blue chip name that everybody loved, and so they were able to issue trillions of dollars of credit default swaps, I'd say they'd be a SIFI, and they'd be particularly a SIFI if they didn't have a lot of assets, because their failure would have a substantial effect on our economy. So I hope that you would look at the liabilities and contingent liabilities of an entity, not their assets, and that would argue for not designating as a SIFI an unleveraged mutual fund, since they don't have liabilities. I
mean, FSOC is, in its analysis, just as you said, trying to identify whether there are specific and well-defined channels by which the failure of a particular organization would have spillovers to the rest of the financial system that would be severe. And it's not just a question of size and not just a question of the assets they hold, but, for example, if there are liabilities and if they are highly runnable and they're a highly interconnected firm, that would point in the direction of systemic risk, as you indicate.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Nagelbauer, chairman of our Housing and Insurance Subcommittee.
Thank you, Chairman Hensling. Chair Yellen, thank you for being here. I want to go back to something you said in 1995. You said this policy, which fits the behavior of this committee, is an example of the type of hybrid rule that would be preferable, in my view, if we wanted a rule. I think the Greenspan Fed has done very well by following such a rule, and I think this is sensible for central banks to do. But earlier you said, I'm not aware of any literature that establishes that a central bank adopting a rule, whether it makes it public or not, is the most desirable way to run monetary policy. So were you for it in 1995 and now you're against it in 2014? I'm having trouble reconciling that.
So, as I said also this morning, I think simple rules can be a helpful guide and starting point in thinking about the appropriate stance of monetary policy. I said that then, and I continue to think that now, and I will say that before every FOMC meeting, I review the recommendations of a number of sensible, simple rules. And so as an input, I regard this as valuable. Now, during the time period that I was referencing in that 1995 statement, that was the so-called Great Moderation, and there actually had been quite a lot of literature looking at the different ways to run monetary policy that established that simple rules like the Taylor rule really could do quite a good job, maybe not the best possible, but quite a good job of delivering good economic performance. And behavior during that time was not bound by a rule, but I think it was good policy, and it had the characteristic that pretty systematically, as the labor market tightened, the stance of policy became tighter, and as inflation rose, policy became tighter, and tighter enough that real interest rates, that nominal interest rates were raised more than inflation. And these are sensible ways to conduct monetary policy, and policy wasn't bound by a formula. It didn't adhere exactly to a mathematical formula. There were sometimes other factors that were important and factored in, but it was sensible. But now in the more recent period, and I continue to think it is useful to look at simple rules and think about their recommendations. What I oppose is tying monetary policy through a rigid mathematical formula to any rule, and we've now lived through a period where those rules would have performed just miserably, and if we had followed them, we would have had dreadful, even more dreadful macroeconomic performance than the disappointing recovery we've enjoyed. And I think that if the kinds of analysis that had been performed earlier that showed that these rules worked well, if you rerun that type of analysis through the period, the last 6 or 7 years, you would find that they would not have performed well. Even so, I mean, I hope that as the economy becomes more normal and as interest rates get back to more normal levels, that the world will be less volatile, and I continue to think that the recommendations of such rules are worthwhile to look at. I've given a number of speeches in recent years in which I've discussed those rules and their recommendations explicitly, and it's something I wouldn't do if I thought there wasn't some value in it. On the other hand, I've tried to explain in a number of speeches why I think they would not have worked and would not have been appropriate in the circumstances
I don't mean to be rude here, but so what I hear you saying is that the rule structure is not totally unacceptable in the Fed scheme here, but you have some...
Not rigidly tying our hands to something, but it's useful input. We have models, we have forecasts, we have a number of inputs into the policy process, and a rule is rules, a collection of them, do provide useful input, and we do take it into account. But I just would not go further than that.
Yeah. Thank you. I guess my time has expired, Mr. Chairman.
Gentleman yields back. Chair now recognizes the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman. Mr. Chairman, I want to ask unanimous consent to submit a report for the record by the Americans for Financial Reform dated July 10, 2014, which I will refer to in my remarks.
Without objection.
Thank you, Mr. Chairman. Welcome, Madam Chair. Thank you for your willingness to participate here, and thank you for your patience. Last month, Federal Governor Tarullo gave a speech in Boston, and he described the stress tests for major banks as the cornerstone of the regulatory response to the recent financial crisis. You tend to agree with that?
I think they have been very important in strengthening supervision.
Right. The idea of the stress tests, as I understand them, is that well, the value in that annual stress test is that we inspect the capital reserves, we inspect the risk management policies within the banks, and when they pass, ideally, when they pass the stress test, there's actually value in passing that stress test because they've got a stamp of approval. Is that the idea behind this?
Well, I think it's really something more than what you just said, is we are using our own models and judgments to take a very detailed look at all of the asset holdings and transactions and exposures of a large financial firm, and we are attempting to assess in a well-specified, highly adverse stress scenario, an economic scenario that is extremely difficult. We're making our own very detailed assessment of whether or not that bank would have sufficient capital to continue to meet the lending needs of the economy and to continue to function. And on top of that, we are insisting that the firm demonstrate to us that they have the ability to do that kind of analysis themselves and in
Okay.
that way judging their risk management capabilities.
Well, you put it much better than I could, but I agree with everything you just said. So the legislation that was offered called the Federal Reserve Accountability and Transparency Act would require the Fed, in Section 4, would require the Fed to publish, to give the information to the major banks that are being tested, all of your methodologies, all of the, I'll read it here, the hypothetical, excuse me, all of the alternatives that are, and public notice and comment rulemaking in advance of any stress test, the detailed, the exact models, the methodologies and assumptions to be used in the stress test. So you'd have to give that, under this new bill, you'd have to give that to the banks. You'd also have to allow them to comment and to help design the test that you're going to give them. Now, in my mind, if you're going to give the people the answers to the test, if you're going to let them design the test, won't there be an assumption that they can now game this test?
Precisely, and that's exactly why we don't give them the models. We want them to, in a sense, show us their work and show us that they have the capacity in their organizations to make well-reasoned judgments about the risks that they face. We absolutely don't want to give them the answers, and when you give the answers, then you don't get to see the work that demonstrates that the student has learned the material and can apply that kind of logic in the unique circumstances that will face that firm, as opposed to just the scenarios that we've laid out. Those firms need to be able to analyze their own unique and specific risks that they face. We set out a couple of scenarios and we do detailed analysis, but what are the unique stresses that could afflict a particular firm with particular characteristics? We want to make sure they have models that will serve to analyze those situations, and they can't just use our models for that, and they need to show us that they understand what the unique stresses are that could hit those firms as well.
I thank you, and I yield back.
Chair now recognizes the gentleman from Georgia, Mr. Westmoreland, for 5 minutes.
Thank you, Chair Yellen, for being here. I want to follow up just on one of the things that Mr. Garrett, one of your answers. You said that Mr. Tarullo is the Federal Reserve representative to the Financial Stability Board. You're his boss, and you are the chairman of the Federal Reserve. And are we to really believe that the gentleman acts on his own without any direction or oversight from you?
Well, I think Congressman Garrett referred to decisions that were made about naming global systemically important banks, and that occurred before I was chair. I'm sure that he consulted with Chairman Bernanke.
Okay, so he's not independent.
Well, no, the chairman obviously has responsibility.
And just to go back to the independence part of the Federal Reserve from the executive branch, I'm sure that you're aware of the 15 chairmen in the Fed's history, that 10 of them have either served at Treasury or the White House. And it seems to be a revolving door type policy between the Federal Reserve and the Treasury Department, and that it actually continues today. And the Fed staff has gone back and forth into the Treasury Department, including in the current administration. So do you believe that this revolving door poses any risk whatsoever to the Fed's independence?
So I think the Fed's independence is extremely important, and I have never, in my many years in the Fed, seen anything occur that led me to believe that it had at any time been threatened. And while I understand the point you're making, I mean, it is essential that the Federal Reserve remain independent.
Okay, and that kind of leads me, and I appreciate it, and that kind of leads me to the next question. You know, we here in Congress have been having a vigorous political debate about infrastructure spending and unemployment benefits to continue. And in your Senate testimony, you dived into this political debate, expressing your support for more infrastructure spending in response to questions from Senator Menendez. In a recent letter to Representative Sinema, who is a member of this committee, you expressed the virtues of extending unemployment benefits. We will continue to debate the merits of this, but do you have any reservations that carrying the water for the Democrats on this fundamentally political issue risks the Fed's independence, impartiality, and indeed its credibility?
So I don't think it's appropriate for me to weigh in on these issues, and I do not interpret what I said about infrastructure to have been telling Congress what I think it should do. I commented, as I recall, to Senator Menendez on the stance of fiscal policy and the way it had been affecting the economy.
So you don't think we need to spend on infrastructure? And that wasn't what you meant by your comment?
I believe it's entirely appropriate for Congress to debate and decide that.
Okay. Was it appropriate just to even talk about? I mean, did you not answer Senator Menendez that that's up to y'all, it's not up to me?
I believe that was the spirit, although I did comment on the fact that fiscal policy had posed a significant drag to economic growth over the last several years.
Okay, quickly, the chairman's staff and the committee staff discussed the Federal Reserve's role in operating a payment system for the Treasury Department with the New York Fed staff.
I'm sorry, a what system? What type of system?
Role in operating a payment system for the Treasury Department.
A payment, okay.
And they discussed it with the New York Fed staff who operate that system. And the staff of the New York Fed described the Fed's role there as Treasury's agent and described the Treasury Department as the Fed's client. Is this characterization, just a yes or no, is that a good characterization of your relationship?
The Federal Reserve is the fiscal agent of the government, and in that sense, that's correct.
Time of the gentleman has expired. The chair now recognizes the gentleman from Georgia, Mr. Scott.
Thank you, Mr. Chairman. I'm over here in the corner, Ms. Yellen. Yes. How are you? I'd like to just take us briefly in another direction, because we don't operate in a vacuum in the United States. And to what extent are the developments in various parts of the world that's taking place now? In Ukraine, you got the situation in Iraq, possible caliphate there, the Israeli-Palestinian situation, Syria. I mean, the world is aflame. And I'm wondering what extent this would have on our global economic growth, and especially the United States economic outlook. But something that's going a little bit unnoticed is another situation, and that situation is Iran. And by Sunday is the deadline, and their decision and agreement is supposed to come out. And in collaboration with all of these other hot spots that's happening around the world, what would be the global impact in terms of economic growth, and where would the United States be? And I know you and Treasury talk in concert on this, and particularly Treasury, which is basically the enforcer of our sanctions, which is based largely on, quite honestly, the well-being of the United States economy. So what would happen Sunday if, one, they don't come up with an agreement and ask for an expansion, or they do come up with agreement that has nothing to do with dismantling, and Israel will not accept it? So Sunday presents a very timely issue, and I thought we might benefit from your thoughts on that, including the other things that are happening in Iraq, Syria, so forth, Israel.
Well, certainly the developments that you're talking about present risks to the United States through any number of different channels. In trying to focus simply on the potential economic impact of these developments on the United States, I would be thinking particularly about energy markets, that we have seen some disruptions in energy supplies, and obviously there could be much larger disruptions in energy supplies, and such developments clearly would have an impact on the United States and in the global economy more broadly. We also look at whether or not there are significant direct financial exposures, for example, of our banking system to particular regions that are troubled. In the case of the set of countries you mentioned, my assessment would be that the direct financial implications for our banking system would not be large. But in times of global unrest, it's very normal to see disruptions in risk aversion, rise in financial markets generally, and that would certainly, were that to occur, have spillovers to the United States and to our outlook.
Okay, thank you. Now let me ask a question on the your asset purchase program, and which I think has done a good job in two important areas. I think it's had played a very major contribution in lowering the unemployment, creating jobs, and very significantly in the housing market in terms of reducing mortgage rates. Is that true? Is that pretty much?
I believe it has made a positive contribution in the ways that you've mentioned, yes.
Okay, now I understand that you are going to end that program within a couple of months. So the issue is, would that have a downturn impact on the progress we've made in both unemployment and housing with this program?
Well, we're continuing to purchase assets, so in that sense, we're continuing to add stimulus. And even if we stop our purchases, our large holdings will be supporting lower long-term interest rates, and I think keeping mortgage rates lower, and will continue to provide a positive for the housing market. If we lacked confidence that the labor market and the economy will continue to improve, we probably would not have been comfortable winding down the asset purchase program. But I do think the economy is improving, the labor market has improved, and will continue to do so.
Has expired.
Thank you very much, Madam Chairman.
Yield to the gentleman, the Chairman of the Oversight and Investigation Committee, Mr. McHenry.
I thank the Chairman. Chair Yellen, thank you for being here.
Thank you.
I know these days are long, but I wanted to ask you about something that I care about. It's Section 113, Part D of Dodd-Frank. And what this, in essence, says is that you will have an annual review of the SIFI designation, right? That there is a mandate under Dodd-Frank that no less than annually there'll be an undertaking by FSOC to review those SIFI designations for non-bank financial institutions. You, as well as Secretary Liu, have both pledged that you're committed to that process, and I assume that remains the case. The question I have is, what metrics are you going to use for review, that annual review?
So, you know, I've not been involved in that. It hasn't come to FSOC yet. I'm not certain of exactly what they will look at. I would assume that they would look at some of the same metrics and whether or not those have changed that they used in deciding to designate those firms.
Well, I'd appreciate it if you'd follow up with me on this to give us an understanding of what that is. This is the 4-year anniversary of Dodd-Frank is next week, and for us to not have an annual review process set up on the SIFI designation is concerning. Now, related to that, you also have, under Section 165, the opportunity for remedies after the CCAR process and the living will process to seek remedies from firms. You know, both Governor Tarullo and former Governor Stein have told us that the CCAR process is moving from a wartime setting to more of a peacetime setting. Then there's a bit of tension between customization and standardization under the CCAR metrics. So once you go through the CCAR process, once you get the review of this stuff, at the end, I'm sure you and your staff pore over the way to improve it for the next time. Are there some key takeaways that we can understand from the CCAR process?
I'm sorry, you're talking about CCAR. You mentioned living wills as well.
I'm sorry. My next question is about living wills. So I put those two together.
You're talking about the CCAR process?
My question is about the CCAR process. My next question, to give you a heads up, is on living wills.
Okay. So I think we've learned a lot from the CCAR process, and you know, we have refined our own modeling techniques, and I think worked with the firms to clarify over time what our expectations are for their risk management and modeling capabilities, and I think we've had good back and forth that's leading to improvements in how we conduct this.
Okay. About living wills. You said yesterday in front of the Senate, I know one senator asked you this question rather directly and apparently wasn't satisfied with your answer about living wills, that you continue to work to improve living wills. Can you give us greater clarity on that? Because you judge whether or not living wills are credible, right? And if you're continuing to work with firms on their living wills, does that mean that they're currently not credible?
Well, we do not make some annual determination as to whether or not they're credible. We may make a determination. We are not required by the statute, but the FDIC and the Fed can make a determination at some point that the living will is not credible of a particular firm or that it would not facilitate resolution. I mean, my own understanding of the process is that this is a difficult and new responsibility for the banking organizations and for us, and that we would have iterations back and forth with the firms and trying to set out a set of expectations, look at what they're provided, give feedback, and set out a set of expectations we want to see.
If the living wills are accepted, then therefore they are credible.
It is accepted is not a does not necessarily mean they are credible. We can determine
that's disconcerting. That's disconcerting because if living wills are intended for that purpose, to help unwind these firms and be a roadmap for unwinding these firms in the event of a cataclysmic event, then they should be credible.
We will work with the FDIC to give these firms feedback on what we want to see them do to facilitate resolution. And of course, that's the objective. But although we're close, we've not even finalized feedback to the firms on their second round submissions.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Green, ranking member of our Oversight and Investigation Subcommittee.
Thank you, Mr. Chairman. Good morning.
Madam Chair, and welcome again to the committee. I have three questions, each of which could easily consume 5 minutes of your time. And I do not believe that I'll get through all three, but I will ask, if possible, that you give a laconic answer to each. The first, you have used the term unusual headwinds, and I've noted that the term fiscal policies have been associated with this. Would you, as tersely as possible, explain some of the unusual headwinds that we have faced or are facing?
Well, tight fiscal policy is one of them, that although there was stimulus for a number of years, in more recent years, fiscal policy in addressing deficits and attempting to reduce deficits has created drag on economic growth. And that's unusual in times like these. In addition, the system of housing finance and the willingness of residential mortgage lenders to provide credit, the standards should have escalated, they have escalated, but it has now become the case that any borrower without a pretty pristine credit rating finds it awfully hard to get a mortgage. And I think there are a number of reasons for it coming out of the crisis, but I think that's a headwind. So credit availability for some purposes, I think, is diminished relative to historical norms. Coming out of this crisis, we also see that households have unusually depressed expectations about their own future income gains. And I think that's weighs on their feelings about their own household finances and is holding back consumer spending. So those are some of the things that I would see as headwinds from the crisis. In addition, productivity growth has really been quite slow for a number of years.
I'm going to abandon my other two questions because I now have a follow-up for this one. You indicated that these fiscal policies are unusual for times such as these. What would you expect usual fiscal policies to be for times such as these?
Well, I think historically when the economy has been weak, fiscal policy is, at least on average, provided greater stimulus than it has over the last several years. And I understand there are reasons that Congress has chosen this course, but simply as what I would see as a factual matter, the degree of drag from fiscal policy in a high unemployment situation has been unusual.
And could you kindly give an example or two of the kinds of fiscal policies that historically have been employed in times such as these?
Typically, there would be tax cuts and increases in spending that would, and allowing automatic stabilizers to go into effect in circumstances where unemployment was high. Now, it's been very rare, we haven't in the post-war period had really a recession that's been as long and as deep as this one, so it's been an unusual period.
Thank you. I'll take one more question and just ask you about indicators. We have leading indicators, lagging indicators, and of course we have coincident indicators. I try to follow these, but what I'd like from you is just as you look at them in general, could you give me just an assessment of where these indicators seem to indicate we're going?
So I see most indicators that I look at in the economy is suggesting improvement. Look at things like industrial production, the labor market, auto sales, what's happening in the housing sector. That may be an exception that we don't see a lot of improvement there. But most measures of spending in the economy, consumer and business attitudes, through all of those, I think we see positive signs.
Thank you very much. Thank you, Mr. Chairman. I yield back.
Chair now recognizes the gentleman from Wisconsin, Mr. Duffy, Vice Chairman of our Financial Institutions Subcommittee.
Thank you, Mr. Chairman, and Madam Chair, thank you for being here. I want to commend you for the last time you were here, staying for as much time as we would need to have everyone on the committee ask you questions. I thought that was fantastic. I was hoping that was going to be a continual policy, but maybe it was not as pleasurable as it was for us, as it was for you. But I appreciate you being here today. On June 18th, Representative Perlmutter and I, along with 84 of our colleagues, wrote a letter to the President asking that he appoint someone to the Federal Reserve with banking experience. I would ask that that letter be submitted to the record.
Without objection.
And I know yesterday Senator Vitter asked you about this very issue, and I think you indicated your support, that you would support having someone with banking experience, community banking experience on the Fed board. Is that correct?
Yes, I would.
And it's fair to say that your role has expanded. Traditionally, you were dealing with monetary policy, but through Dodd-Frank and the Fed's own action, you've had an increased role on the regulatory side, correct?
Yes.
And we were familiar with your dual mandate of maximum employment and price stability. Is it almost fair to say there's an unwritten third mandate that would bring us to protecting the country from systemic risk?
I think that's fair to say for the Federal Reserve, although it's not something that applies specifically to monetary policy, but we have a number of different tools, and I interpret that as an unwritten third mandate for the Federal Reserve.
Right. And kind of talking about that, right, you have the monetary policy side, and you also have the regulatory side. And just on the good government side, for us, we get concerned not about your blackout period during the FOMC meetings. We agree that you should have the blackout period. We do get concerned in Congress when you take the blackout period that applies to monetary policy, and when we ask you to come in and talk about the regulatory side, you use the argument on monetary policy and the blackout and use it for
we have no blackout period that applies to anything other than monetary policy in the economy. There is no blackout period with respect to supervision and regulation. And, it's conceivable that you ask someone to testify and they had a problem with I don't know what specifically you have in mind here, but our blackout period does not apply to supervision and regulation.
Thank you, and I would agree with you. It does not apply, but I would just reference, we had a December 2012 meeting, and there's a number of examples, but in December 2012, we wanted to have a hearing on Volcker, and we didn't get a witness because the blackout period was cited. So just if you take a look at that, we want to make sure that there is a blackout period that does not apply to the regulatory side.
It does not apply.
Okay. I wanted, if you haven't noticed, this side of the aisle gets very concerned about the debt. I think that's why the chairman at our hearings will put up the fact that we have a almost $6 trillion debt. By way of your accommodative policy, quantitative easing, we've had historically low interest rates. You would agree? Today, I think through the Budget Committee, we'll pay $227 billion a year to service our debt. And you would agree we pay historic low interest rates on that debt, correct?
Yes.
Have you taken a look at what it would cost to service the debt if interest rates go to historic norms?
Well, I don't have those calculations in front of me, but certainly the Congress should be thinking about the fact that over time, as the economy recovers, interest rates will move back up to more normal levels.
And the cost to service that debt does not stay at $230 billion. Even if we were able to stop that clock from turning and we were able to hold it at $17.6 trillion, the cost to service that debt is going to increase dramatically when interest rates go up, correct?
Well, it will certainly increase.
Well, so there's not a correlation?
Yes. Higher interest rates will increase the cost of servicing that debt.
And some of the projections I've seen, if the debt stayed the same, it brings us to around $550 billion a year, an additional $300 billion that doesn't go to whether we're building our defense, whether we're using that money for food stamps, the social good of the country. And I think it's important that the country understand that there is a consequence for the spending binge that this town has gone on, and that we will pay it as rates go up, and it will have a significant impact on our budget in our out years, which might start, as you've indicated, next year. Thank you for your testimony. Thank you for your honesty in actually answering our questions. I appreciate that. It's very nice and refreshing. With that, I yield back.
Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Cleaver.
Thank you, Mr. Chairman. Madam Chair, thank you for being here. I want to talk about unemployment because that continues to be a major concern of mine and frankly, a major concern in the district that I represent. And obviously, the macroeconomic situation is thriving, but when it comes to unemployment, particularly for minorities, it's still almost in recession levels. And I'm wondering if you think that is some kind of a structural unemployment issue, or do you believe in is it called Luddite? Is that how you pronounce it?
Luddite?
Yes.
So I think the labor market is afflicted both by weakness in the overall economy, and so things should broadly improve as the economy strengthens and the unemployment rate and other broader indicators come down. But on top of that, there are also structural factors that are currently and have for a long time been creating problems for many, many American families. And Luddite tends to refer to technology, and we've seen a widening of the income distribution, the wage distribution in the United States going back to the mid-'80s. Economists have been debating the causes, and they do see technological changes that have favored skilled workers as being one of the causes of a widening income distribution. To some extent, globalization probably also plays a role, and there may be other factors. But I think when we think about all of the pressures that middle and lower income families in the United States are facing, some of it comes from the generally weak economy, and I think that's the part the Federal Reserve can contribute to. But there are deeper adverse trends at work on top of that, and perhaps they have even been exacerbated during this downturn.
Well, some economists seem to believe that as technology expands, that it will create more jobs than it will destroy. Do you embrace that economic theory?
So I think the total number of the jobs in the economy is not just determined by technology, it's determined by macroeconomic policy. So I wouldn't believe people have for centuries worried that advancing technology, for example, would destroy jobs and people would become unemployed just because technology enables more to be produced with fewer workers. And time again, we've seen that's not the case, that even with productivity growth and improving technology, we can have jobs with appropriate policy for people who want to work. So I don't endorse that, but patterns of technological change can favor some groups in the labor market and disfavor other groups in the labor market. And many economists have been writing about the fact that so-called skill-biased technical change, in part the use of computers and new information technologies, has raised the productivity and the income-earning capacity of more skilled workers and has worked to the disadvantage of less skilled workers. So technological changes can produce winners and losers, at least in a relative sense.
Yeah, the latter restaurants, for example, I've seen that. I've said here in the committee before, I went to a restaurant in Cape Girardeau, Missouri. I'm from Missouri. And you order your meal from the table through a computer. which means that there is no waitress or waiter with that job now. But that still doesn't answer for me at least, the question about a cure for the unemployment levels that are so high in urban centers. Even if you are a college graduate, if you're an African American or Latino college graduate, you're still going to have a difficult time getting a job. Now, there may be some sociological. Thank you, Mr. Chairman.
I hope that will improve in a stronger economy.
Time of the gentleman has expired. The chair now recognizes the gentleman from Indiana, Mr. Stutzman.
Thank you, Mr. Chairman, and thank you, Chair Yellen, for being here today and for your testimony. I'd like to talk a little bit about the dual mandate, and your comments in your testimony are that you're making progress towards the Federal Reserve's objectives of maximum employment and price stability. One of the things that we're starting to see in Northeast Indiana is there is demand for labor and even some wage increase. One of the concerns that I have is in the long term, how do you, I believe that the dual mandate is conflicting, and would like to hear some of your thoughts, and how do you decide when is the right time to increase interest rates? How do we grow the economy but keep inflation in check? One of the things that I do believe is that the dollar is a unit of measure. It's something that we use to measure a current value. Shouldn't it be stable just like any other measurement, whether it's a foot, hour, pound? Should it be stable like those measurements?
Well, almost every central bank that has an explicit inflation target has chosen a low positive number as their objective for inflation rather than zero. And there are a number of reasons for that. One reason is that if zero is the target, one is bound to have episodes of deflation, which can be associated with very highly adverse outcomes, which almost every country wants to avoid.
So let me get to inflation. The Fed's favorite measurement of inflation is the PEC deflator. Is that right?
Yes.
Okay. Is that a leading coincident, or is it a lagging indicator?
Well, I'm not sure I quite understand what that means.
How do you gather information? What information are you gathering to then declare that we are seeing inflationary pressures?
Well, the PCE price index is issued. Data on it comes out every single month. It's produced by the Bureau of Economic Analysis. So we have monthly data on it, and so we're measuring, and the Bureau of Labor Statistics is going out and collecting data on a wide range of goods and services that they incorporate into the consumer price index. So we have pretty good real-time data on prices in the economy.
Is wage growth, is that part of the calculation?
So it is not explicitly part of inflation, but in trying to forecast inflationary pressures. So one question is, what is the price level or inflation now? Another question is, what is its likely trajectory over time? And in trying to understand and forecast where is inflation going.
How much is wage increases calculated into inflation?
Well, it doesn't directly enter into inflation, but the prices of some goods and particularly services depend very heavily on the cost of labor.
So would the
it's
cost
an important influence on the rate of inflation.
So we're trying to get wage increases, is that correct?
Well, we are trying to hold stable the or to have 2% growth in an index
But
of
why wouldn't we
consumer
want
prices.
unlimited wage increases? I mean, why wouldn't we let the market drive wage increases?
Well, we are letting the market drive wage increases.
But if we
don't have a target for wage increases. We have a target for increases in the
am I not
prices.
understanding that wage increases would then factor into inflationary pressure, and then you would take that into calculation for interest rates?
We have an objective for a price index that is a broad measure of the cost of a basket of consumer goods to the typical American consumer. And that is, we are trying to achieve a longer-term objective of 2% for that. And looking at wage behavior, we don't have a target for wage increases, but wage increases can be a determinant of inflation of goods and services and have predictive power for inflation in the future.
The time of the gentleman has expired. The chair now recognizes the gentleman from Minnesota, Mr. Ellison.
Thank the chairman and ranking member. Good morning, ma'am. Good to see you again. You know, just with regard to this issue of wage increases and the implication that they could be a driver of inflation, could you speak on the relationship between increases in wages and productivity? And if you have an increase in work productivity, you can also have increases in wages that are not inflationary. Could you comment on that?
Well, that is certainly true. And often, instead of looking at just wages, we would look at a different measure called unit labor costs, which compounds together both productivity or output per hour and wage or compensation costs. And you know, that's a broader measure, taking account of productivity, of what does it cost, or how is the cost changing over time, of what firms need to pay basically to produce a certain amount of output. So certainly productivity is a key factor, and not only wages. You know, over the last several years, what we have seen is that real wages, or wages in real terms, are not growing as fast as productivity.
Yeah, thank you for making that point. I was going to ask you, but you anticipated my question, which is that, you know, we have room for wage increases given our rate of productivity in this economy. And I would argue that our wages are depressed and and sometimes you need government to intervene in labor markets through a minimum wage in order to catch up, because there's no equality of bargaining power given the decline of union representation in our country. Anyway, I have to ask you a question on behalf of my constituents. I represent a very large percentage of people whose roots are in Somalia, and very proud to represent that community. One of the problems we've been having is that because of certain regulations like the Patriot Act, Bank Secrecy Act, and others, that the regulatory, I hate to use the term regulatory burden because that sounds so Republican, but but the regulatory burden, okay, it's my move on bipartisanship today, is such that a lot of the banks that facilitate these money wiring transfers are opting out of that market. Usually we're not talking about them remitting a lot of money, and the banks tell me they do it, but it's just expensive, and the liability associated with making a mistake is pretty high when it comes to having to do all the documentation of knowing your customer. What could be done? Because we got hardworking people who are trying to send money back home to their families, and our government correctly is trying to stop terrorism financing, which I completely support. But in so doing, you know, a lot of folks are very hard pressed to get money back home. Could you speak to this issue?
Well, this is an issue that the Federal Reserve has been aware of, and it's been discussed, I know, on an interagency basis for a number of years. It is certainly a legitimate need to make remittances to Somalia, and I think part of the issue is with the need to also manage money laundering and terrorist financing risks. This is a hard issue. I'd say the Federal Reserve, I think it's important to understand the Federal Reserve absolutely does not prohibit businesses from providing remittances to Somalia to the extent that the banks we supervise are involved with customers who are in this business. We would supervise to make sure that they are abiding with BSA AML requirements, but we are not prohibiting banks from serving the needs of these customers. Now, it's a decision that they make whether or not they want to take these risks. And, I know this is not the only area where this comes up. Some firms may be reluctant to undertake those risks.
Well, let me. Forgive me, Madam Chairman, because time's running short. But I think that one of the ways to solve this problem is for maybe some developed governments like ours to engage with the Somali government, which seems to be getting its feet on the ground, and help them stand up their central banking system so that it can meet international standards. I think this would be very good money well spent to help them get their processes in order, so that, because every penny that Somali Americans send to their families is a penny we don't have to send in foreign aid. But we're not going to stand by and let people starve, so we will step in if we need to, and remittances take a lot of pressure off. Thank you very much. I yield back.
Time of the gentleman has expired, and the chair would note for the record he is aware of many accusations against my friend from Minnesota, but sounding like a Republican is not one of them. The chair now recognizes the gentlelady from Minnesota, Ms. Bachman, for 5 minutes.
Thank you, Mr. Chair. Continuing on with the Minnesota line of questioning here in the Financial Services Committee, my question for you, and thank you again for coming before this committee, Chairman Yellen, today. As of July 9th, 2014, my understanding is that the bank reserves at the Federal Reserve are something close to $2.8 trillion. And I'm wondering if you could explain to the committee, why is this number so high, the amount of reserves that are on hand at the Federal Reserve? Does this show that businesses are leery of investing in the U.S. economy? And if these reserves enter the economy too quickly, what is your assessment on the impact of inflation if this $2.8 trillion adds to our money supply too quickly? And what, if anything, would the Federal Reserve do to stop this inflation?
Well, the reason that bank reserves are so high is because we are creating those reserves when we purchase longer-term assets. So we have been involved in a program of purchasing longer-term Treasury and mortgage agency mortgage-backed securities in order to provide financial conditions that are appropriate to stimulate the recovery. And when we purchase those assets, we create those reserves. It's not any individual bank can decide what they want their deposits to be with the Federal Reserve, but in the aggregate, that total is determined by the Federal Reserve and not the banking system. Now, as the economy recovers and we come closer to our goals of maximum employment and our 2% longer run objective, it will be appropriate for the Fed to tighten monetary policy to avoid inflation picking up to undesirable levels. And we can do that with a balance sheet that's as large as we have, with reserves at these high levels. And we have been discussing the exact procedures we will use when the time comes to normalize policy. We've had a number of discussions in recent meetings, and the minutes of our last meeting I referred to in my testimony give some details of our thinking. We hope to set it out in detail before the end of the year, but we will move to raise short-term interest rates when the time is appropriate. We will use tools like our ability to pay interest on excess reserve. reserves, and a host of subsidiary tools that we can use to move up the general level of short-term interest rates. And that's how we'll tighten monetary policy. Eventually, the committee sees it as appropriate to operate with a much smaller balance sheet and smaller reserves than we have now. And so looking into the distant future, I think it's quite reasonable to predict that our balance sheet will eventually shrink in size, but only much later in the process of normalizing policy.
You had touched on the issue of recovery. We've been in recovery for approximately 6 years. That seems like historically a very long period of time, unusually long period of time for the United States economy to be in a so-called period of recovery. Normally, when we have a recession or if we have a backtracking in our economy, usually we see almost like a bungee cord effect. We see the economy grow at a rapid pace. We haven't seen that for the last 6 years. Can you tell this committee why haven't we seen what historically we would see robust recoveries, but we do not see them now? Why, in your opinion, has that happened?
I think because this downturn was caused by a financial crisis, and the study of financial crises around the world suggests that when they occur, the downturns that follow them and the recoveries take a very long time, and they have a pronounced effect on the economy. The typical post-war recession.
But so much of the recoveries, isn't it true that so many of the recoveries, usually the further down you go, you see a quicker move up in recovery? Why aren't we seeing that?
Well, I think that's when it's not caused by a financial crisis. For example,
what makes it different?
Well, for example, in 1980, 81, we had a tightening of monetary policy because inflation had risen to unacceptably high levels. And when inflation came down, there was the ability to then step on the gas with respect to monetary policy, and interest-sensitive sectors like housing that had been suppressed, that immediately began to grow and bring the economy back. And of course, this is a very different episode.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Washington, Mr. Heck.
Thank you, Mr. Chair. Chair Yellen, thanks very much for your presence today. I want to follow up on a question that Congresswoman Velasquez asked you about what you highlighted in your own testimony, your increasing concern about reach for yield activity. I effectively have concluded you've placed it kind of on your watch list, and your amber line is on. The follow-up question is this: can you, without speaking to broad policy, nonetheless give an example of what it would look like in order for you to take that from your amber light to your red light? And secondly, an example, again, not the broad policy, about what kind of an action step you might take to deal with it. Is that clear?
Yes. So I would look at broad measures of leverage and the extent of maturity transformation and credit growth and asset prices generally. Broad measures, if I saw leverage growing rapidly in the economy, asset prices rising to levels that were outside of historic valuations.
And what's an example of what you might then do?
Okay, so an important thing that we have done is to take steps to make the financial system stronger. So all the steps coming out of Dodd-Frank to increase the quantity and quality of capital, to put in place tougher leverage standards. These all different things. Liquidity rules. I won't go through the full list of them. But let me just say these do two things. First of all, if we were to have an unwinding of imbalances that occurred, it means that financial institutions and the financial sector would be in a much stronger position to withstand the shocks and to go on meeting the credit needs of the economy than they were in the run-up to this crisis. But second of all of those, or meant the collection of rules we've put into effect and are now completing, we have to work our way through them, will work to restrain the buildup of these imbalances. For example, we will expect to put in place or likely to put in place measures that will require extra capital holdings against short-term wholesale financing. That discourages the buildup of leverage and overnight borrowing that creates these risks.
Thank you. Financial institutions should be put on notice as of now. I want to ask a question about the output gap, the difference between actual economic activity and that which would be sustaining maximum employment and peak industrial output. The IMF puts America's output gap at $720 billion a year. The CBO puts it at $1 trillion. What is your personal opinion of about what it is?
So we don't have any official...
I know, I asked your personal opinion, Madam Chair.
Okay, so can I put it in a slightly different metric?
You will anyway, so please go ahead.
The unemployment rate is 6.1%. Members of our participants in the FOMC would see a normal longer-term unemployment rate in the range of 5.2 to 5.5%. Taking the lower end of that range is, say, a 0.9% gap in terms of the unemployment rate, a simple historical relationship that's fit pretty well. This is just back of the envelope, it's not precise, called Okun's Law, would say that...
Okun's?
Called Okun's Law, after Arthur Okun, would say that the output gap tends to be on the order of 2 or 2.5 times that in terms of a percentage of GDP. So I think that gets us in the range of something like 2 or a little bit over 2% in terms of an output gap. But I want to emphasize that's a back-of-the-envelope calculation. I'm trying at your request rather than any official. But I think that probably is in line with what you said, but I'm not sure.
Thank you, Madam.
Time of the gentleman has expired. Chair now recognizes the gentleman from South Carolina, Mr. Mulvaney.
Thank you, Madam Chair. Last time you were here, you and I talked briefly about some discussions between Treasury and the Fed in the fall of 2013 regarding the debt ceiling and the possible prioritization of payments. I sent you several questions for the record in follow-up to that. I received a response last week, which I appreciate. And I have to ask, just for the record, ma'am, do you actually read those, or do you just, done by staff and you sign them?
I absolutely read them.
Thank you. You didn't answer a lot of my questions. I had asked for specific folks names of specific folks who were involved in those discussions. I asked, for example, you had invoked a certain privilege. You said you couldn't tell Congress what you had talked about because you have an agency relationship with the New York Fed and you couldn't tell us what you talked to them about. And I asked you for a specific legal justification for that privilege, and you didn't answer that. So without wasting a lot of the time to actually get the answers, which I'll do in a follow-up QFR today, do you think it's appropriate not to answer congressional inquiries on QFRs?
Well, I think we've answered to the best of our ability the questions.
Good, and I'll give you a chance in the follow-up to point out in the answers you gave where you're actually answering those questions. Let's get to the substance of the answers, because you gave me a very interesting answer, one that I've heard from members of the administration several times, where you distinguish between a default on debt and a default on obligations. It's a term that has changed over the course of the discussion regarding the debt ceiling. It used to be that not raising the debt ceiling would supposedly lead to a default on the debt, and then members of the administration changed that language to use the term default on our obligations. And you've continued that verbiage in your response, where you said a failure to pay Social Security benefits, contractors, our armed forces, etc., and other obligations as they come due will in fact be and will be viewed publicly as a default by the United States on its obligations. And I won't go in now to Social Security benefits, contractors, armed forces. I'll ask you this. We spent $1.9 million last year on lifestyle training for Senate staffers. Would not doing that be deemed a default by the United States on its obligations?
Well, I really can't comment on a specific like that. I would simply say that the government has a wide range of obligations to contractors, to Social Security
They do.
recipients.
Would you agree with me that some are more important than others?
That is not my judgment to make. That is up to Treasury and to the Congress to decide, and not to me.
But I guess if you're taking the position that not paying any of the obligations is a default, then not paying the $300,000 we spent to encourage Americans to eat caviar last year would be a default.
When the government has incurred, purchased goods and services, and is presented with a bill that has come due for those goods and services, and it fails to pay bills when they come due.
Fair enough, but not paying things that haven't yet incurred and become due would not be a default then in your definition. So if we have an expense that we're going to incur next month, but we do not, and therefore it does not come due, it's not a default using your definition.
Okay. I mean, the Treasury is making payments.
Let's
as
move on
bills come
to the
due.
other topic I want to talk about, because we received a letter last week or late last month from Sheila Bair, former head of the FDIC, regarding the new reverse repo facility at the Fed. She had raised some concerns about it. I think the president of the New York Fed and also the Boston Fed raised some questions about it in a recent Wall Street Journal blog. Two questions as quickly as I can. Number one, why did you not come to Congress to seek authority to create that facility?
Well, this is a repurchase agreement, which is a standard tool that we use in open market operations. It's long been
True, but this is a dramatic expansion, which is why you're doing it, I think, correctly on a test basis. Correct? This is a new facility for you. It may be a reinvention of something you have used or a recharacterization, but it is a new facility. So I guess the answer is you didn't think you needed authority to come to Congress?
Well, we do have authority under the Federal Reserve Act to purchase and sell securities in the open market and in conduct of monetary policy, and I believe it falls under standing authority that the Federal Reserve has, and we will use this facility for the purpose of only for the purpose of implementing monetary policy.
Fair enough. And let me ask you this. Do you share Mrs. Bair's concern and that expressed by the presidents of the New York and Boston Fed that perhaps this facility needs to be limited in its size and application?
We have discussed and are aware of the potential, if it's available on very large scale and can be expanded and contracted very quickly, to create financial stability risks. And we absolutely intend to make sure that we address those risks.
Thank you, ma'am.
Time of the gentleman has expired. The chair now recognizes the gentleman from Nevada, Mr. Horsford.
Thank you, Mr. Chairman, and to the ranking member, thank you, Madam Chair, for being here today. It's been a very informative session on the state of the U.S. economy. An area that I wanted to explore from the monetary policy report is the issue of the slow recovery of housing in the housing market. I'm from Nevada. We have the most unstable housing market in the country. About a third of our homeowners are upside down, negative equity, some of them as high as 50% or more. And so in the report, it indicates that while there was a slight increase in values and an uptick in the housing market, we're beginning to see a decline or a slowdown in that. And so I wanted to ask what forces are contributing to this lackluster housing recovery.
Well, you know, housing did seem to be recovering throughout most of the recovery, and it looked like it was on a reasonably solid course, recovering from a very low level. And then we saw essentially a cessation of progress when mortgage rates rose significantly last year. I think my expectation was that that would be a temporary setback for housing, and with mortgage rates higher, but still at very low levels, and with a period of very weak household formation, I expected that, we would see a rebound by now, a pickup in the housing sector, and frankly, it continues to be sluggish, and I can't give you a precise reason why that's occurred. We're certainly aware of the fact that mortgage credit remains very, very tight, as I've said several times this morning, for a wide range of borrowers, and that may be part of it. We also hear about some supply constraints that builders face. Perhaps that's contributing, but I have to say that I'm somewhat surprised.
So what more do you think the Fed can do to help stimulate recovery in the housing sector, both for those homeowners who are upside down in the values, as well as to help new entrants be able to qualify for homes?
Well, housing prices are continuing to increase, and they have increased substantially, and I think particularly in the markets that saw the worst booms and busts. So I know particularly in Nevada there are a very large fraction of homeowners who are underwater. But I think if you look at the aggregate numbers, just the increase in house prices we have seen, and I think that is in part reflecting our accommodative monetary policy. Many fewer borrowers are underwater. The numbers have diminished substantially, and I know the Las Vegas area particularly is one of the most hard hit and still has about the highest numbers on this. But I really think that's helping, and I think eventually we will see greater progress in the housing market. But there are many impediments that servicers face in the aftermath of the problems and the foreclosure problems we've had during the crisis, and things have not yet settled out there.
Definitely, definitely. At yesterday's Senate Banking Committee, you stated, quote, "Too many Americans remain unemployed, inflation remains below our longer-run objective, and not all of the necessary financial reform initiatives have been completed." What benchmarks are you looking at when determining if a full recovery has taken place, and what does a full recovery look like from your perspective?
So we've emphasized that at this stage we're not looking at just one or two statistics in assessing the labor market. We're taking into account many different measures of performance. Probably the unemployment rate is the single best indicator, and it's come down to 6.1, which is really notable progress, and broader indicators that include marginally attached workers, discouraged workers, and those with involuntary unemployment, part-time employment. Those have come down as well. But that's not at levels that most members of our committee would consider full employment. We're looking at the extent of long-term unemployment. We're looking to see if there are groups that have dropped out of the labor force labor force participation has declined so much. I am hopeful that some of that will reverse as the economy strengthens. We're looking at measures of hiring and quits that remain below normal and suggest not a normal labor market at this point.
Time of the gentleman has expired. The chair now recognizes the gentleman from Florida, Mr. Ross.
Thank you, Mr. Chairman. Chair Yellen, thank you very much for being here. In your role, you are balancing the metaphorical gold standard of our currency, and I know that can be very difficult. In your opening statement with regard to the monetary policy, it says that the committee seeks to explain its monetary policy decisions to the public as clearly as possible, and trying to keep it as clearly as possible for my constituency back home, especially those who are on fixed income. What hope or what prognosis can you give clearly as possible as to those on fixed incomes? Is it positive? Is there an opportunity that they're going to see greater returns on their investments, or they're going to have to see, eating into principal? Or fixed income people in Central Florida, there are a lot of them.
I mean, I know it's been a really hard time for savers who are trying to exist on the returns you would earn on a safe investment like a savings account, and that's been a heavy toll for
it has, and it's
those
led to
households.
abbreviated retirements and return to the workforce. So that might be one of the reasons why unemployment has gone down.
But they can be hopeful that as the economy recovers, and interest rates in a sense, they're not just set arbitrarily, they reflect fundamental economic forces, and the fundamental
that you control,
force
fortunately,
here,
or unfortunately, depending on who you're talking to. But yes, you're right.
well, it's a lot of savings and not much demand for those savings in the form of investment, and that means that
But as you discontinue the buyback, I think that should hopefully put some more pressure on upward rates for savings. Would you not agree?
well, as the economy recovers and we begin to normalize policy, eventually interest rates will go up. So if the recovery continues, I would envision rising interest rates over time, and we've tried to spell out what we envision.
Thank you. Let's talk briefly about SIFIs, because the last time you were here we discussed this, and specifically I think you would agree that the fewer systemically important financial institutions we have, the better off we are. And in fact, we've now got some insurance companies that are being designated SIFIs. My big concern is that they should be designated as a SIFI as a last resort when nothing else is out there to help them. I think you'd agree with that.
Well, sure. I mean, I think there has to be clear evidence.
Yeah, but when they're at that level, should we not allow for some opportunity for self-correction or an opportunity so that they can keep from being designated as a SIFI? In other words, these entities don't know they're a SIFI until it's too late. Would you not agree that there should be more transparency, more involvement, whether it be some role for the Fed to come in there and keep them from being a SIFI? And would that not send a message to keep others from also ever being designated that and taking appropriate action?
Well, I think the FSOC is tried to make clear what the criteria are that they will take into account. And I don't really think it was any surprise to these institutions that they're on the list. And of course, after they're designated, if they wanted to change their structure substantially enough, that situation could potentially change.
Real quickly, I see that you've just engaged Commissioner Tom Sullivan to assist in capital standards, and I think that's a very good move. Is there some? I want to make sure that we're adequately representing this industry, this insurance industry, especially with regard to international capital standards, and that has me concerned because I think you've testified yesterday that maybe even if there are international standards, that we may not abide by them, and that.
Well, what I said was that if international standards are agreed to, nothing becomes.
We're not compelled to do it.
Nothing happens in the United States unless we go through a full regulatory.
But we're still going to be at the table, though, with regard to the negotiation of those standards, correct?
We are sitting at the table, and state insurance commissioners are there with us. We consult with the Federal Insurance Office, and as you noted, we are adding.
I've got just one little quick question, last question. Just recently this month, the President was speaking, and he says, quote, right now, if you're one of the big banks, profit center is the trading desk, and you can generate a huge amount of bonuses by making some big bets. You will be rewarded on the upside. That's going to require some further reforms, the President said. That's going to require us taking looking at additional steps that we can take. Have you talked to the President about further reforms?
No.
Okay. Do you think that Dodd-Frank is appropriate in terms of its reforms that have been imposed on the market so far?
I'm not certain what he's referring to there.
Okay. Thank
you. Time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Royce, Chairman of the House Foreign Affairs Committee.
Chair Yellen, how are you?
Good, thank you.
I'm glad you're with us again. I want to encourage you on a theme that you spoke to recently, and that is this question of the unsustainable path, as you mentioned, of entitlement spending that we have known about for decades. And there's a new Congressional Budget Office report that just came out, and it releases new numbers. It says that the long-term debt will equal 100% of the overall economy within 25 years. I think this goes to your point that, in your words, this is a critical issue facing the country. I talked to Ben Bernanke about this and his predecessor, Alan Greenspan. You know, isn't there a way to ring that bill a little louder so that people understand what this means for the next generation? And I'll ask you that and give you the floor here to amplify that message if you'd like.
I believe this is a critical problem that Congress should really try very hard to address in the administration. It's one we have known about for decades. There's nothing fundamentally new here. We've just come closer to the problem without taking the necessary steps. I think, you know, it relates to trends in health care costs combined with an aging population that is certainly not news. There are many, you know, organizations that have been trying to explain, I believe, to the American people how serious this problem is.
Well, I want to encourage you to continue to do what you're doing on that front. If I might recommend opening every speech with trying to get people's attention, both in Congress and around the country, about this problem and what it will mean for future generations. I also have a fiscal policy question for you, and it's on an issue that I find myself in agreement with our current Treasury Secretary on. We must do more to discourage these inversion transactions, and that's the use of mergers and a change of the P.O. box to avoid paying higher taxes here in the United States. And in 1997, in your confirmation hearing, you said that the tax structure impacts decisions about work and investment. Other things equal, lower taxes are better than higher taxes. I'm wondering on the corporate tax part of this, if you've looked at this issue of inversion or if you have been involved in any conversations about the impact of our current tax system and relatively high marginal corporate tax rates on job loss. And is this something you've discussed with Mr. Liu? And on comprehensive tax reform, including a reduction of U.S. corporate tax rates, that's one possible solution, right, to this problem. I wish we had, as you say, I wish we had more than a letter from the Treasury Secretary calling for, you know, the words here that he used was a new sense of economic patriotism. We're going to need more than that new sense of economic patriotism. We need real leadership. And we need leadership out of the White House, and we need leadership all around to pass a comprehensive tax reform. Only Reagan made it possible in 1986, in my view, and he did that in engagement with Tip O'Neill, right? And only an engaged president will make it possible today. But could you speak to this inversion issue and what we might be able to do?
Well, I'm sorry to say this is an issue. While I'm aware of it, I'm not an expert on it, and it's a complex set of issues, and I think it's entirely appropriate for the Congress and the administration to frame policy to deal with it, but I don't think it's appropriate for me to give specific advice about how
I understand that, but we are going to continue to lose ground in terms of, you know, economic productivity that you've spoken to in the country. If companies continue to change their domicile, we're going to lose receipts, we're going to lose jobs. All of that's going to compound that problem that we spoke to earlier, which is, you know, now the long-term debt equals 100% of the overall economy 25 years from now under current trajectory. So if we want to change the trajectory, you know, we've got to do something, in my view, about this problem as well.
Sure. I mean, I think it's entirely appropriate to try to frame appropriate policies to deal with this issue.
Thank you, Chair Yellen, and thank you, Mr. Chairman.
Time of the gentleman has expired. The Chair wishes to announce that we have 3 members left in the queue. It's the Chair's intention to clear these 3 members and excuse our witness. So if there are members monitoring the hearing in their offices wanting to hasten over here to ask questions, do not bother. The chair now recognizes the gentleman from North Carolina, Mr. Pittenger, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chair Yellen, for being with us again today.
Thank you.
Chair Yellen, Alice Rivlin, who was President Clinton's appointee to be vice chair of the Fed, endorsed the cost-benefit analysis requirement of the FRAT Act. Do you agree with her?
I'm sorry, what did she endorse?
She endorsed the cost-benefit analysis of the FRAT Act, the bill that we've been discussing today with Mr. Huizinga. Do you agree with her?
Well, I believe the Federal Reserve does do cost-benefit analysis where it's appropriate. When we
do you believe it's appropriate in this case?
I mean, I don't endorse the version of what's required in the FRAT Act, but I think we do appropriate and detailed and careful analysis of alternative ways to implement a law or a regulation that implements a law that's passed by Congress. Rules.
I appreciate what you're saying, Ms. Yellen, but so the bottom line is that you would not agree with Ms. Rivlin on this.
Well, I didn't have a chance to review her remarks, but I wouldn't endorse what's in the FRAT Act.
Chair Yellen, we saw a recent report from the CBO that Obamacare is estimated to cost 2.5 million jobs over the next decade. Has the Fed done any estimates of how many jobs the implementation of the Dodd-Frank is expected to cost the economy? Or is the Fed even interested in this?
Well, as in evaluating a number of different regulations, we have attempted to do cost-benefit analysis. And the overall conclusion we came to, for example, when we looked at our capital rules, was that the reduced probability of a financial crisis, which takes an enormous toll on jobs, and we've just lived through that so we can see how large that can be, that the reduction in the odds we would live through a period like this again resulted in benefits that exceeded the costs of implementing higher capital standards.
We sure are seeing it in North Carolina. In my district alone, the building permits aren't even up to 50% of what they were in 2008. That's a lot of lost jobs. Same is true with community banks, the consolidations. There's been a lot of impact. I would think that a measurable effect of Dodd-Frank would certainly be warranted. Chair Yellen, with the lackluster growth we've had, though, there's been some bright spots. One particularly is in the energy sector. The Dakotas, Texas, Oklahoma, and other energy-producing states have had great job growth, particularly as it relates to the energy revolution that's come from the fracturing and other production of fossil fuels. Chair Yellen, what effect would opening up other resources, the OCS, expanded drilling areas on land and water across the U.S. have on the GDP? And what type of impact would that have on job growth?
Well, I would agree that we have seen a remarkable growth in the energy industry and a transformation of energy, our dependence on the rest of the world for energy. We don't do calculations in the Federal Reserve of the type that you've asked about, what impact it would have on GDP.
But it is common sense. You would agree that if we opened it up to the OCS and other lands and ANWR, that it could make an even greater measurable difference.
Well, I mean, as you know, there are complicated policy issues and a number of different factors that come into play. And, you know, I think that's not in the domain of the Federal Reserve to opine on what's the right public policy in this area.
Given the right political atmosphere, it would create jobs. Chair Yellen, the Federal Reserve is now in the business of regulating insurance companies and currently supervises 2 insurance companies which have been designated as CFIs, AIG and Prudential, and nearly a dozen insurance companies that have owned depository institutions, the likes of Nationwide Insurance, State Farm, and TIAA-CREF, to name a few. Chair Yellen, other than one appointee that is now on that board, recently hired senior advisor with an extensive background in insurance. How many full-time employees has the Fed hired with insurance expertise in the last year, and do the hires possess a particular insurance expertise?
I can't give you a number, but I can tell you that we have worked hard both at the board and in the reserve banks to increase our expertise. We're working closely with the Federal Insurance Office, with state regulators, and are trying to tailor supervision.
Thank you. We're out of time. It does make sense, though, doesn't it? Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Pennsylvania, Mr. Rothfuss.
Thank you, Mr. Chairman, and thank you, Chair Yellen, for being with us today. I'd like to talk a little bit about the Federal Reserve Accountability and Transparency Act, which has been some discussion today. And what I'm hearing from across the aisle with our colleagues, I've heard talk of a straitjacket. And then I think I heard you testifying about a, quote, rigid rule that you described in the proposed legislation. Is it your testimony that this bill requires the Fed to follow a rigid rule for monetary policy?
Well, it requires us, as I understand it, to specify a rule, and when we don't follow it, to explain exactly what the logic is or how we have changed the rule, and then calls for very rapid GAO involvement in overseeing the conduct of monetary policy if for any reason we were to deviate from the rule. And
you see, I look at the Act and I see two rules described, a directive policy rule and a reference policy rule. Now, the reference policy rule does set forth parameters for calculating a funds rate, but there's no requirement in this Act that would require the FOMC to follow the reference policy rule, correct?
Well, that's what I see in the legislation.
And so then we have a directive policy rule that simply requires the Fed to identify an interest rate. I mean, that's what the Fed is already doing when it announces a policy. It identifies an interest rate and an explanation of what the FOMC is doing. If we were to boil down the directive policy rule, that's essentially saying we're going to say there's going to be interest rate and an explanation of what the Fed, if FOMC is doing. Is that right?
Well, I think we regard it as incumbent upon ourselves to explain why we've adopted the policy we have.
And so that's what we're talking about here.
No,
and the added requirement that you would explain or educate the members of Congress and the American people why you would deviate from a standard that was in place similar to what was happening during the Great Moderation.
It requires the specification of a mathematical rule and models and forecasts, which goes much, much, much further in straitjacketing how we would set monetary policy than setting an interest rate and providing Congress and the public with an explanation of the rationale for our policy decision, and then would bring to bear on Federal Reserve decision-making very quickly in real time, oversight from the GAO and from Congress, and I believe bring into the process of Federal Reserve decision-making essentially short-term political influences. And I don't believe
I'd like to talk a little bit about the independence of the Fed. Again, another focus of our hearing today. Does this apply to the Fed's regulatory responsibilities as well as its monetary policy?
It is an exception that Congress made for monetary policy.
When we talk about writing a cost-benefit analysis requirement into law to ensure that the benefits of the Fed's regulations are greater than their costs, the same requirement that currently applies to the SEC and the CFTC, we hear that judicial review under such a statute would compromise the Fed's independence. Does the Fed's independence require that the Fed be exempt from review of its rules by the courts?
I mean, the term, to me, Fed independence applies to monetary policy, and I feel the cost-benefit analysis that we do is adequate, but that's a separate matter.
Okay. I wanted to follow up on Congressman Pittenger's line of questioning about the designation of insurance companies as SIFIs. Other than hiring Thomas Sullivan as a senior advisor, what steps have you taken to ensure that the Federal Reserve has the requisite expertise to regulate insurance companies?
Well, we have hired individuals with that expertise, especially when we have taken on the oversight and supervision of savings and loan holding companies, some of which have heavy insurance involvement, including the ones that the Congressman mentioned. And we have really greatly built our expertise in understanding the insurance industry and its unique characteristics. We have explicitly, when we came out with our 165 rules, refrained from putting in effect capital rules that would apply to heavily insurance-based companies in order to make sure that we thoroughly understand their unique characteristics.
Thank you, Chairman.
Time of the gentleman has expired. Last but not least, another gentleman from Pennsylvania, Mr. Fitzpatrick.
Thank you, Chairman Hensarling. I also want to thank Chair Yellen for the investment of time you've made here. I think you've been very generous with your time, which I know we all appreciate. Number one issue in my district back in Bucks County, Pennsylvania, is jobs and the economy. And there's been much said about what appears to be a government rate of improving unemployment rate and what that says about our economy. And you've talked about that both in your policy report and your written statement here today. And your oral statement, Chair, you said that the unemployment rate has fallen nearly 1.5 percentage points over the past year. It stood at 6.1% in June, which is down 4 points.
The gentleman will suspend. The clerk's having a little trouble hearing the gentleman. If you could speak a little closer to the microphone.
Yeah, much has been said about the unemployment rate, fallen 4 points from the height. My concern is that these government numbers don't seem to distinguish between full-time employment and part-time employment.
I'm sorry. If the gentleman would suspend one more time, for whatever reason, the clerk still can't hear the gentleman. Would you mind using the microphone adjacent to you, and let's see if that corrects the problem?
Is that better?
Perhaps the microphone for Mr. Westmoreland might work. I apologize. Let's try this.
Okay, Chairman, in March, you gave a speech about what the Fed is doing to tackle the unemployment rate. And you made this observation, this is a quote: "The existence of such a large pool of partly unemployed workers is a sign that labor conditions are worse than indicated by the unemployment rate." That was the National Interagency Community Reinvestment Conference in Chicago. It was back in March. Do you believe that the unemployment rate, as currently reported by the Bureau of Labor Statistics, is an accurate snapshot of the labor market?
Well, it's one particular measure, but it's obviously not complete. And the Bureau of Labor Statistics reports on the number of individuals who are part-time employed and involuntarily so would like more work. And that figure has been running about 5% of the labor force, which is an unusually high level. The Labor Department computes some broader statistics pertaining to unemployment. One of them is called U6, and it's the standard civilian unemployment rate with those involuntary part-time employees added in, and also those who are discouraged or marginally attached to the labor force. And that's a number that is much higher. It's running around 12%. It's come down significantly along with the narrower measure of unemployment, but clearly what's called U3, or the 6.1% unemployment rate, is not a complete measure of what's happening in the labor market. And that's why we have said, the Federal Reserve, the FOMC has said, we are looking at a broad measure of indicators, including many indicators of the labor market, to assess where it stands.
Because many, here on the legislative side look at the unemployment rate, I guess it's the U3, which is 6.1%. They're looking at that to drive policy decisions on spending, on programs, and the like. So which do you think is the better reflection of the true employment picture of our nation? Because, most my constituents are they're not buying the 6.1%. It doesn't feel right. They know it's not right. It's not an accurate reflection of what's really going on in the economy in real towns across America.
I mean, so that's why I believe you have to look at many measures of the labor market, and there obviously is more distress than is captured in that 6.1% number, and the 12%, for example, or roughly U6 measure is capturing a broader range of distress. But there are many metrics. We can't judge something as complicated as the labor market by one number.
I'm sorry, Chair. Is there anything in particular that the Bureau of Labor Statistics can do to create a more accurate picture of the economy?
I think we shouldn't try to look for one single number to assess what's a complicated phenomenon. If I had to choose one and only one number to look at, I would choose the 6.1 U3 number, but I don't think that's adequate, and I think we should want a broad range of measurements of different aspects of the labor market and to keep them all in mind.
I remain concerned by this, these monthly reports that say the unemployment rate is coming down, not counting individuals who are or distinguishing between those who work part-time, those who work full-time, not counting individuals who are not actively engaged in the search, who have given up on the search. People are desperately looking for work. They're not reflected in the numbers of the government that is supposed to care about them.
I agree, and I mentioned my own concern with some who are simply measured as out of the labor force who might rejoin and want work if it were available.
Chair, thanks for your service. Appreciate it.
Thank you.
The time of the gentleman has expired. I'd like to thank Chair Yellen for her testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing stands adjourned.